The yen plunging more than 2% after sticking with stimulus, including yield curve control. The Nikkei surges. Losers and winners, Wall Street punishes Goldman Sachs while rewarding Morgan Stanley after earnings highlight the diverging fortunes of the two legendary banks. Plus, it is day 3 at the World Economic Forum, where we will have more blockbuster interviews, including State Street's CEO, Ron O'Hanley, and Norwegian Wealth Fund CEO, Nikolai Tangen. Let's take a look at the futures then. European futures pointing up. It is all about the BOJ and investors digesting that decision, not only to stick with yield curve control, but ultimately as well to extend it by changing the loans being offered to banks, kicking the can down the road then for the BOJ, the implications across these debt markets. And of course, we talked about the drop in the yen, the rally in JGBs, and the gains that you're seeing across Japanese equities. We're going to break that story down for you with Kathleen Hayes out of Tokyo in just the next minute or so. Here, the FTSE 100 gaining down 2 points, I should say. The Spanish IBEX, though, is gaining 0.2%. Here in the UK, digesting the CPI data that fell for a second straight month. 10.5%, though, is the year-on-year number that you got for the month of December. Money markets increasingly speculating on rates here in the UK, getting to around 4.5% by around September. And the pound, by the way, and we'll look at that later in the show, currently close to a 5-week high. The FTSE 100 currently down about 0.1%. Over in France, the CAC 40 is off by 4 points. Also digesting comments from the ECB's Villeroy, who of course is the Bank of France's head and sits within the governing council of the ECB, suggesting that the guidance from Madame Lagarde in December around 50 basis points remains valid. That after a Bloomberg scoop yesterday, suggesting that officials are considering a step down in March, possibly to 25 basis points. Let's switch it over and see how things are looking cross-asset then. After the modest losses that we saw across Wall Street yesterday, futures pointing to gains of around 0.2%, staying above that 4,000 level. The 10-year, 347, there has, of course, been a particularly strong move across these bond markets. Money flowing in, yields off by about 7 basis points across the benchmark here in the US, of course, on the 10-year, and you saw those moves on JGBs, again, linking to the decision by the BOJ to stick with yield curve control. 130 now on Japanese yen, that weakness still there, down 1.6%, and Brent rallying $86 a barrel, that's a gain of 0.9%, as Liu He over in China, or at least he's in Davos, the Vice Premier of China, saying that growth will return to pre-pandemic levels later this year. Their expectations there'll be greater demand then for that commodity later this year. Let's get back to the main market story of the day, though. Bank of Japan Governor Haruhiko Kuroda says he doesn't see the need to widen the yield range further. His comments come after the BOJ chose to maintain its yield curve control program, defying calls to abandon the policy. For more, I'm joined by Bloomberg's global economics and policy editor, Kathleen Hayes, who is in Tokyo for us. Kathleen, the big surprise, of course, was no change. You've been following us through the morning. You've been listening in to that press conference. What did we hear?
Well, and first of all, let's remember that this was not a big surprise to everybody. There were two camps. One camp going into this was the sober economists saying, and even some former Federal Reserve, BOJ officials saying, no way, it's too soon. You don't move from December and then 4 weeks later, widen the band again, the band of yield curve control, keeping that 10-year JGB, the benchmark government bond, just tethered around 0, but putting the ceiling at 0.5 from 0.25. And so the other camp was traders investors saying, but wait a minute, since this December move actually seemed to rile up the bond market, selling bonds like crazy, forcing the Bank of Japan to buy bonds like crazy. Surely this is going to make them accept and acknowledge that it's no longer sustainable and the bond market isn't functioning well, so it's time to make a change. He didn't do that. And what's interesting about the press conference is how much he defended and pushed back against that. He says, the view of the Bank of Japan and the market don't have to be the same when he was challenged on this issue of the bond market having one view and him having another. He still sees, he says there's no particular risk from the bond buying in general. And the big thing that's so interesting is this change in funding operations. I don't think anybody paid much attention to funding operations for buying bonds by banks, partly because it had a zero rate, so charged on it, and it just didn't seem to be an issue. I mean, that seems like a pretty good deal. He says in the press conference, so in other words, now they're going to change that to make it even more easy and more attractive for banks to buy bonds. He says the BOJ won't rule out the chance of charging negative rates in future operations. That means he's leaving on the table the possibility that the BOJ would literally pay banks to buy JGBs, effectively lend them, say, $100 billion to purchase JGBs, but only have to pay back $95 billion. Isn't this interesting? And what it may be suggesting is that, yes, the bond market is not functioning well. Yes, while yield curve control is going to have to be shifted, maybe you'll have to even just do something like say, we're going to buy 2 years notes instead of 10-year bonds. But for now, they have to keep this process going. And look, there's going to be a new governor in place very, very soon. We're going to hear the nominations for deputy governors and the governor in the first couple of weeks in February. Then they'll be voted on, and we'll know probably, in fact, we will know before the March 8th meeting. That's going to be Governor Crow's last meeting, who the next governor is going to be. Crow steps down on April 8th. The next governor will have his or her first meeting on April 26th. This strikes me to a very large extent as just keeping the boat going, keeping it afloat, keep rowing it ahead, and not making any major changes. Well, we don't know yet why then, if you had that kind of attitude, why did you bother to do a tweak in December? Perhaps the Bank of Japan thought that it would just smooth things out and buy more time. But it's pretty clear that Governor Crow doesn't seem to have any view of doing anything more unless they come up with some interesting tweak that isn't just changing the band, doing something else. But for now, it looks like this is what the bond market is going to be living with, at least for the next few months. And even when the new governor comes in, any kind of change in this program, say they just got rid of yield curve control completely tomorrow, everyone says this itself could have huge bond market implications, not just in Japan, but around the world.
And therein lies the global significance. Excellent. Bloomberg's global economics and policy editor Kathleen Hayes kicking the can down the road, buying extra time, but remaining, at least for now, the BOJ an anchor, at least part of an anchor for these global bond markets. The yen remains under pressure, of course, 130. How long that will live is, of course, dependent on any future changes to that yield curve control policy. Currently down 1.6%, and the Nikkei rallying on the back of weaker yen, currently up 2.5%. Coming up, we will go live to the World Economic Forum. Do not miss our interview with State Street CEO Ron O'Hanley. That is next. This is Bloomberg.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
This week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins this week, only on Bloomberg Television and Radio.
Welcome back to the Open. We are almost 10 minutes into the European trading day. You're seeing gains of 0.2% as investors weigh up the decision by the BOJ, not just to stick with yield curve control, but arguably as well to enhance it. The yen is under pressure. Futures in the US gaining 0.2%. The euro bid as well, currently gaining 0.4% at 108 on the back of comments from the ECB's Villeroy that 50 basis point high guidance from Madame Lagarde in December remains valid. Speaking to Francine Lacroix in Davos, and talking of Davos, the World Economic Forum has returned, of course. It is the annual January event. After that 3-year hiatus, the business and financial elite are, of course, in Davos discussing a range of urgent global issues, including the climate crisis, energy security, and political stability. Bloomberg's Francine Lacroix is in Davos with another special guest. Francine.
Tom, thank you so much, and good morning from Davos. Cold, I want to add, cold Davos. I'm here with Ronald O'Hanley. He's the chairman and chief executive officer of State Street. Thank you so much for joining us, Ron. We were talking when you arrived, of course, in the green room about the mood in Davos, and I don't know whether you feel that it's a little bit too optimistic. I mean, we worry about the U.S. debt ceiling. That's a huge deal. We still worry about inflation. What's your outlook for 2023?
Yeah, so I would agree with you that it's more optimistic than I expected, and it is true that we're seeing some moderation in inflation and some good signs. Supply chains have started to repair themselves, but it's still early, I think, to say that it's all over. I think that if you think about the United States, I mean, you still have a very, very tight labor market in most areas. That tends to provide inflationary pressure. You've got the situation in China with COVID, and we just don't know if that will result in any kind of production problems that will become inflationary. You still got a lot of fiscal stimulus that's working its way through the system and will result in at least it'll have good impact, things like the Inflation Reduction Act, but in my mind, it's too early to be optimistic. And then lastly, and maybe most importantly, there's a lot of geopolitical risk out there. We don't know what's going on in Ukraine yet in terms of what that outcome will be. And by the way, in the United States, the potential for a debt ceiling fight.
So first of all, how do you view the U.S. debt ceiling issue? Is this something that could turn ugly? If we talk about the 24th hour, could we go into the 25th? And could we even see a U.S. downgrade?
Yeah, the idea that we're even talking about this after what we've seen in the past, to me, is very disappointing. This is about money that we've already spent, money that we've already borrowed, and that we need to actually honor that. So this is not the way a political fight should occur. I think that markets have not priced it in. They don't typically do. until it gets very close, but it would be catastrophic if this got pushed through to a actual we're not going to pay our bills.
Ron, we also had the keynote speech from the Vice Premier of China yesterday, and then a few select financiers got to meet him also privately. Were you given assurances that China is reopening in the right way?
So I think I'm actually optimistic about China. I think the Biden administration has done very good work with China. I think there's a recognition that while there could be some select decoupling, and there needs to be, if you think about chips and things like that, I mean, these are two major trading partners, and China is an important trading partner to the rest of the world. So some of the personnel moves that apparently have been made in China, I think, are strong signals. So again, it's far from over, and it's not the situation that we enjoyed, back in the mid of the last decade. But I'm more optimistic about that from a geopolitical perspective. I think, again...
What does that mean for the economy? So we have Janet Yellen also meeting with the Vice Premier, I think in about an hour in Zurich, 2 hours away from Davos.
Yeah.
Is this good news?
I think it is good news. I think to the extent to which there can be some certainty. But listen, you've already... We've seen peak dependence on China from most parts of the developed world, certainly the United States. I think you've already seen a lot of supply chain reconfiguration. I'm told that, in fact, if you look at the port of LA for several decades, most ships came from China. The largest single one now is Vietnam. So that's a sign, that's actually a healthy sign to me, that there's less dependence. But we've got a long way to go, and a lot of things can change.
How much bigger do you want to grow the company? So there was, you tried to buy a company which ended up not happening.
Yep.
Why, and does that mean that you have that capital to deploy elsewhere?
No, so listen, State Street is a very different bank, right? We do two things. We manage money, and we support those that manage money, what we call investment services. These are both scale businesses, and to the extent to which we can get more scale. And there's scale because the technology investment is enormous, and many banks have decided that it's not where they want to put their put their capital. For us, it's our core business. So to the extent to which we have an opportunity, we will. Having said that, our organic growth has been, we're very pleased with our organic growth.
But do you think you'll buy something? I mean, you're talking about opportunities. Are you actively looking for an opportunity? Because valuations are cheap.
Yeah, we're not actively looking. I mean, this is a small market, though, so we tend to know what's going on.
Any part of the world that you want to be more present in or bigger, or it's just really opportunities that come up?
Yeah, so we're a global custodian and a global asset manager. So, and what tends to happen is as economies develop, first it starts out as a banking and an insurance economy, and then it becomes an investment economy. So, and economies are still growing, particularly in the emerging markets. So we will look in all parts of the world for opportunities.
Ron, what's your take on what's going on with crypto? I know you also tried to do not actually something in crypto per se, but kind of like on the back end. Does that continue? Does it change your plans because of what happened with FTX?
Yeah, I think what's going on in crypto is that there is not a consistent regulatory framework out there. Some basic things, as we saw in FTX, weren't occurring. Custody, right? What custody means is that the assets are segregated and can't be used for purposes other than what the client directs. So until there's that kind of framework, I think there'll be limited institutional investment interest in it. I think regulators recognize that something needs to happen, but I think they're also happy that what happened at FTX really didn't transmit to the banking system.
So do you think that regulators are afraid of touching crypto in case they get it wrong, or they just misunderstand it for the moment and so on to want to be more knowledgeable before they get involved?
No, I don't think they're afraid, but I think, I'm generalizing now, but I think what happened is the technology moved so fast and the regulators didn't keep up with it. Part of it was moving so fast, nobody really knew where it was going. But now we have a sense in terms of what happened with FTX, and a lot of people were affected, but the system wasn't.
So how long do you think it'll take to regain that trust, meaning that you can get involved in terms of selling products at a bigger pace?
Well, I would separate crypto from digital assets broadly. And I think there's still a bright future for tokenization. There's a lot of central banks thinking about central bank digital currencies. So I think that's proceeding forward at pace. And I think in terms of crypto as a broad-based investment asset, I think we're going to have, I think it'll be a while before we see that.
All right, Ron, thank you so much for joining us today. That was Ron O'Hanley there, the State Street Chief Executive Officer. With that, Tom, I'm going to send it back to you in London, but we'll have plenty more interviews throughout the day here in Davos.
Francine, another great interview. Thank you very much. Of course, Francine Lacroix on the ground in Davos, the CEO of State Street there, saying broadly optimistic on China. Geopolitical risks, of course, remain a concern. Not actively looking for M&A at this point. Plenty more coming up. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. 21 minutes into your European trading day. You're seeing gains across European equities of 0.2%. Futures in the US also positive. Euro is rallying, currently trading at 108. That's a gain of 0.6%. Of course, the Japanese yen remains under pressure, down 1.2%. It has paired some of the earlier losses, though. It's previously in the session down more than 2%, currently trading at 129 after the BOJ sticks very firmly with yield curve control. A couple of individual stocks to bring to your attention. Earnings season, of course, 3 misses on the earnings front, but nonetheless, all stocks in the green. Let's start with Just Eat Takeaway then. Rallying, as you can see, a little over 15%, despite the fact that Q4 orders missed estimates. Orders fell 12% year on year. The expectations were for a fall of just 5%. But executives saying that growth will come in 2023, and they think it's going to be skewed towards the end of the year. Richemont, of course, within the luxury space, and very much tied to the China story, rallying, as you can see, 1.7%, despite the fact that they saw a miss as well. China sales falling 23% because of the virus surge there. Comparable store sales at the top line, rising 1% in the fourth quarter. The expectations had been for an increase of 1.4%. Nonetheless, you're seeing a rally, or at least a gain for that stock. Burberry, similar picture as well, gaining 0.6%, also wrestling with the challenges in China. They saw sales falling around 24%, 23% in the last quarter as well. They face store closures. They do expect that things will improve towards the second half, currently gaining 0.6%. So luxury in focus, and some of the ordering online food takeaway companies as well. JustEat.com rallying a little over 15%. Now, let's get back to a big banking story. This is really fascinating, the divergence that we're seeing now. Rivals Goldman Sachs and Morgan Stanley are diverging pretty significantly. Their latest earnings report saw Goldman ending Tuesday as the second worst performer on the S&P 500. Its longtime rival was the second best share gainer on the index. Joining us for more on this, we are joined by Nicholas Comfort, our European finance reporter. Nicholas, why two very different stories from these big legendary banks on Wall Street?
I think it's a question of investors saying sort of the one bank has a really firm idea of what the strategy is, and the other bank is still kind of grappling with the end of it's called an identity crisis. So on the one hand, you have Morgan Stanley, who have been expanding in wealth management very decisively over the last couple of years, with expansions, with acquisitions, but also organic growth. And then where that really paid off in terms of net interest income in the rising rates in the wealth management business. On the other hand, you have Goldman Sachs, who had these grand plans for consumer banking expansion as a digital bank, and it just didn't really work out. And they have been pulling back that plan sort of in various steps, but also facing just large losses in the consumer banking business because of credit provisions on the one side, but also there's the cost of building a bank from scratch, and then realizing that it wasn't maybe what they wanted to do in the first place.
Yeah, listening to James Gorman, of course, of Morgan Stanley, really fascinating, saying that we do not face an identity crisis. We know who we are. So maybe a bit of a nod to some of their competitors, possibly Goldman as well, as they wrestle with that retail part of the bank. What are the lessons for European banks as we gear up for the European banking season? What are you going to be looking for?
Well, I interest rates, clearly, that's a big one. There's been a lot of debate as to how long sort of banks can continue to be earning more on loans before they have to start paying out more on deposits, especially as sort of the ECB's loans, the TLTROs expire. So that's a big question, which we can have read across from the US banks, but also in terms of trading as well. We have great, in all fairness to Goldman Sachs, there were great results in that debt trading business. So what does that mean for fixed income heavy banks like Deutsche Bank, for example? Barclays also be interesting to see how that plays out for them. These banks are well positioned in the macro business. That means anything exposed to interest rates and government bonds, interest rate swaps that people are using to hedge against inflation. So that'll be very interesting. But also the credit trading side, so corporate bonds. That's an area we saw pain at the US banks. Will we see that continue at Deutsche Bank, for example? Equities, bit of a disappointing quarter, got to say, in the US. So what does that mean for UBS, for example, which is big in equities? What does it mean for the French banks, too? On the investment banking front, so the advisory side, it was a bit of a disaster at US banks last year, and the same at European banks. I don't think we're going to be seeing much bright light in the fourth quarter for deal making at European banks.
Okay, Bloomberg's Nicholas Comfort breaking down that divergence, that fascinating divergence. The stock moves were pretty substantial yesterday on Wall Street with Goldman Sachs and Morgan Stanley. And then, of course, a look ahead, a nod to what to expect from European lenders as well as they prepare to report their earnings from the end of this month. Thank you very much indeed. Now we continue our conversations, of course, with industry and political leaders in Davos. Let's get over to Bloomberg's Manus Cranny on the ground at the World Economic Forum with another guest. Manus, good morning.
Tom, a very good morning to you. Yeah, we're live from Davos. We've got the asset owners queuing up. Will the Emiratis bump into the Norwegians in the green room? Joining me now is Khaldoon Al-Mubarak. He leads Mubadala. They deploy capital. Welcome to Bloomberg.
Thank you for having me.
Good to see you this morning. The mood music has shifted. Olaf Scholz says no recession in Europe. François de Gallo says they will avoid recession. Describe for me your outlook. Has your mood music on global recession obsession shifted?
So I think our mood is more of cautious optimism. I think the last 2-3 quarters, particularly Q4 of last year, was very negative, and I think that mood spilled over markets all over the world. And then you're seeing today the shift that you're describing. From my perspective, I think there's no doubt there's some headwinds. There's challenges ahead. I think that's clear to everyone. but it's not as bad as I think many people thought it would be. So I think whether it's a recession or a lighter recession, my view, 23 will be okay.
Have you, as an asset owner, mentally already got to 5% for the Fed and 3.25% from the ECB? Is that what you mentally are already thinking on deployment of capital? Will we hit those levels, first of all, clear the decks on central banks, and then we'll move on?
Yeah, I think if you look at the data is clear. I think you can see where the data is going. You can see how we closed out the year and then our expectations for Q1, Q2. I think on interest rates, on inflation, I think, whether we are at the peak or close to it, I think we can clearly see the light where this is going. And I think that gives us clarity thematically. I mean, as you know us, we're long-term investors. So whether that's a 1, 2, 3 quarter event, it doesn't change our perspective in terms of how we invest and where we're going.
And as I was walking up the steps, I was thinking, as a global asset allocator, Larry Fink said yesterday, we're going to come from 9% to 3%, and then we've got to begin to think about deploying capital on a higher for longer. Are you preparing for higher for longer, and what does that look like?
Well, our DNA has always been higher for longer. We are long investors. Where we invest and the sectors we invest in, we take themes, we take a 5-year to 10-year horizon. Our teams then move and deploy capital in that space, and then we pivot when we need to pivot. But essentially, that's always been our approach.
But are you in pivot mode at the moment? Is there anything that's saying, look, team, we need to pivot, we need to shift the gears? Is it more credit allocation? Is it more diversification away from America, from that US focus? What's the pivot in play?
So I would say not necessarily pivot. I think thematically, let's start with that.
Okay.
The themes of the spaces we like to invest in and we are investing in, be it semiconductors, be it technology, be it the energy transition, which is obviously a big space for us, digital transformation, digital infrastructure, software, and of course, credit, which comes in, particularly, I think, in the next short to medium term. So I think these are all themes we've been actively deploying capital in for the last 5 years.
Yep.
These are themes we are very much, I think, for the next, as I look at the next 5 to 10 years, I think these are all themes we will continue to invest in. Now, in terms of, the world, the U.S. remains, I think, a very, very stable economy, and I think when it comes to innovation, when it comes to the size and liquidity of that market, will remain, I think, a very important market for us. Asia, I think, is very promising, particularly if you look at what's happening now in this post-COVID era, China coming out, India, of course, with what we've seen in terms of growth rates in 2022, 21, and what we expect in 23, what you're seeing in very exciting economies like Indonesia, Southeast Asia, and even Japan and Korea. I mean, Korea is a very interesting economy too. So I think Asia is going to be another area, is going to be an area of focus for sure for us as we go forward.
Let's take a little bit more into China. Everybody's obsessed about this reopening. Secretary General from OPEC was here yesterday. He said, calm yourself. Wait until the fourth quarter before we can really see a pivot. You agreed to deploy, I think, about $10 billion of capital. That was in 2015. Now, if I've got the math right, hopefully we're not in for a correction, you've deployed 5. As China reopens, are you set to really scale up your deployment of capital into China with the China Development Bank?
So we have a very strong platform that we've built in China. I think we understand the Chinese market well. We have a strong team of investment professionals based in China. I expect for 2023, I think, a strong recovery in China. I think we're seeing the signs already. The opening up was faster than many folks, I think, expected.
Did it catch you short?
So I was expecting an opening up, not as fast as it has come. So I think that's definitely, but it's a positive. I think that's a positive. I expect that the results of it, we will start seeing in probably the second and third and fourth quarter. I think that's where we see that halo. So I think they'll come up with a strong growth year, China, and with that, I think opportunities. We're well positioned to continue to invest in that economy. I think it's a very interesting economy with a lot of opportunities. I think any country with a population of over 1 billion, with a growth rate of between 4 to 5%, I think for sure is going to be very interesting.
What accelerates the deployment of capital? Well, first of all, will you get to the full $10 billion deployed in capital over the next year, the next couple of years?
So we've already, I think, invested substantially, and I think we will continue down that road, and we will comfortably meet our targets.
Biggest opportunities in technology. We know that that's what your sort of pet topic is, whether it's US or China, deployment for capital in tech, will it be more East and China than it is America in the near term, medium term?
It'll be global. It'll be global. We're looking at tech and venture everywhere in the world. We're well positioned in the U.S. market. We're actually very excited in Europe in that space, particularly. A lot of interesting things happening in that space in Europe. Asia as a whole, you mentioned China, but don't ignore India, don't ignore Korea.
Will you expand in India and Korea? Is there more to deploy in India and Korea relative? Maybe I've misrepresented it. Do you think there's additional deployment in India and Korea?
Yes. So I think in terms of our portfolio, when I look at our portfolios, we're relatively undervested. In Asia as a whole, and particularly in economies like India and like Korea. You will see us certainly look more into these areas as we see very interesting opportunities in the sectors we like.
We have Janet Yellen and Vice Premier Liu meeting today. How important is that there's a step up and forward and positive between US and China relations for you as you stand globally?
Well, I think it's positive for the world, not just us. I think stability is good. I think temperature down is good. I think a return to a form of comfortable globalization or global connections is good for the world, good for the economy. So I think, and then for us as global investors, it's a net positive.
Now, you have a significant holding in Fab. Big story, big scoop for Bloomberg, Fab, going after Standard Chartered. You're a big shareholder. Did you push that bid? Would you support a rebid?
So, of course, as you know, we're shareholders in many financial institutions. Fab is obviously one of our major holdings, but also other holdings. I can't comment on activity, particularly for public companies. I think that's for them to speak about.
Building a national champion. Let me go at it one more way.
You can try.
I can try. Building national champion, is that what that is about for the UAE? Is that the ambition? Additional national champions in banking?
So I think, you know us well enough. I think, and if you look at thematically in terms of everything we do, we build national champions. We've done that in semiconductors. We've done that in aluminum. We've done that in renewable energy. It is a global game. It is a game where scale matters. And I think we get that, and we work on that.
To close off in just 30 seconds, liquidity is draining from the global economy. Do you stand, is that your biggest opportunity? Manus, I'm here, Mubadala, I'm going to be prepared to fill that gap of liquidity. Is that your opportunity?
Humble pie first. Nobody's going to fill that liquidity. I think we have, I think, a role to play. I think we've been responsible investors. We will continue to be responsible investors. As we look at 23 and beyond, I think what you will see Mubadala do is what you have seen us over the last 10 years, 5 years do.
Khaldun Al-Mubarak, great to have you with me. I love somebody that runs a sovereign wealth fund that can admit there's a moment for humble pie and asset deployment. Khaldun, thank you so much for joining us here. Excellency, great to have you with us today. So that's the first asset owner. Let's see what deal he can do with Noor's Bank as he pops back into the green room. Tom.
It keeps coming. Excellent stuff, Manus Granny. Thank you very much indeed. The CEO, of course, of Mubadala, being cautiously optimistic on the prospects for the global economy this year. Let's get back to what's happening across the Eurozone, though, particularly with the European Commission and the Trade Commissioner saying that Europe needs to be realistic about being able to resolve its issues with the US over a controversial climate act. Brussels is concerned that President Biden's Inflation Reduction Act unfairly subsidizes American companies, posing a threat to European industry. Very pleased to say I'm now joined by Valdis Dombrovskis, the European Commission Executive Vice President, who is also in charge of trade. Sir, thank you very much for your time this morning. You've been speaking with the US trade head, Catherine Tai. Have you been able to squeeze out any further concessions from the Americans regarding the operations of European businesses in the US in relation to the Inflation Reduction Act?
Good morning. Indeed, yesterday we had discussions with U.S. Trade Representative Catherine Tai, who was here in Brussels, on Inflation Reduction Act, on a range of other topics. Well, on Inflation Reduction Act, we have, I would say, somewhat positive outcomes as regards clean vehicle tax credits. But obviously, there is still further work to do on other elements of Inflation Reduction Act, like clean vehicles subsidies, batteries, critical minerals, and so on and so forth. There are some openings from U.S. Side, but we need to see them really kind of coming to the tangible solutions. And as some of the now delegated acts are being prepared for March, we need to use this time to make sure that also EU concerns are addressed.
Okay, so the clock is ticking. You've made some progress when it comes to those tax credits for electric vehicles. You touched on this, batteries, and the subsidies within the IRA, the Inflation Reduction Act, are pretty significant along the supply chain. What specifically are you hoping and are you expecting some concessions from the Americans when it comes to batteries?
First of all, we must see what is a list of battery components to which the Inflation Reduction Act discriminatory subsidies actually applies. We must see like inputs like critical minerals, where we're seeking solutions that EU could have, so to say, a free trade agreement partner-like treatment as regards those critical minerals. So there are several ways how we can deal with this issue, and as I said, there are some openings from US side, but we really need to make sure that we produce concrete results. So we continue our engagement at various levels with Biden administration, and also our dedicated joint task force is continuing to work.
The European Commission President von der Leyen yesterday outlining a plan, the EU Green Deal Industrial Plan. How does that address some of these concerns? And are you convinced it's going to go far enough? Is industry in Europe convinced it will go far enough?
Well, as regards this European Green Deal industrial plan, well, I would say it's broader. It's not only addressing issues related to Inflation Reduction Act, but EU competitiveness issues more broadly, because we had been affected by a number of shocks related to Russia's aggression against Ukraine, high energy prices, so there are broader issues where working to address through this European Green Deal so that issues which are trying to address through this new initiative. In any case, we're looking at issues related to state aid, so how to adjust our state aid framework while keeping the integrity of single market and level playing field among EU member states, how we can deploy better our joint EU financing instruments to support our industry, and other avenues.
And explain to us, Commissioner, what are the risks, for our viewers, what are the risks of loosening those state aid policies across the Eurozone?
One of the EU's main achievements is EU single market. So we need to preserve the integrity of the single market. We, in a sense, need to work to strengthen the single market, not to weaken it. And one of the important elements of a single market is that there are common rules of game which ensure level playing field. And state aid rules are an important part of this. Therefore, when we are discussing adjustment of state aid rules, we need to be mindful that in EU there are countries with different levels of economic development and correspondingly different fiscal capacities to support their industries. So we need to ensure that there's no unfair competition developing within the single market.
On the economy, there's increasing, possibly cautious optimism about the direction of travel for the European economy. Is the worst behind us?
Well, what we are seeing indeed that since autumn we had seen some positive signs. Well, first, energy prices had fallen lower than previously expected because, well, our gas storages were full at the beginning of the winter. Also, the winter has been relatively mild so far. We also see the Russia's oil price cap functioning. So all in all, it's easing some of the pressures. We see that our crisis response like recovery and resilience plan and is delivering. It's helping member states' economy. So indeed, we are expecting shallower economic contraction around the turn of the year than it was expected previously. Maybe we can even escape this technical recession, and also inflation seems to have peaked. It has come down markedly in December. But also there, the core inflation still remains elevated. So yes, there are positive signs, but we need to stay vigilant. There are still a number of issues we need to address. And also as regards energy, yes, our gas storages were full for this winter. But this winter, there was still lots of Russian gas in our gas storages, which was filled in the first half of the last year. This is not going to be the case this year, so we'll still need to seek alternative gas supplies and ensure energy supply security also for next winter.
Commissioner, thank you very much for your time, as ever. Greatly appreciate it. Valdis Dombrovskis, they're echoing that cautious optimism around the European economy. The European Commission Executive Vice President, of course, and charged with trade across the Eurozone. Also saying there have been some progress in terms of talks with the US on the Inflation Reduction Act, but a number of areas still need to be addressed. Let's get more now from the World Economic Forum. We are, of course, bringing you some fantastic interviews with some of the key players in Davos this week, and we have another one coming up now. Bloomberg anchor Lisa Abramovich is, of course, on the ground for us at the World Economic Forum. Lisa, good morning.
Good morning, Tom. Yes, indeed. And that guest is no other than the CEO of the biggest sovereign wealth fund in the world, Nikolai Tengen of the Norwegian Wealth Fund, which manages $1.3 trillion. Nikolai, today we are talking all about what's going to come in markets, how we're going to see. And last month you urged some of your traders to act in a contrarian way. What does it mean to be contrarian for a $1.3 trillion fund that in some ways is the market?
Yeah. Well, contrarian, of course, means to try to do the opposite of everybody else, and that's where all the money is. I mean, if you are right in a contrarian way, you will do much, much better. And that's kind of the philosophy we try to install increasingly amongst our traders and our portfolio managers.
What does that mean in terms of specifics here? What is sort of the common thought that you would lean against?
Well, I thought it was much easier last year to be contrarian because it was clear that, you know, with so much negative rates that there was one way they could go. A lot of people selling out of the integrated oil and energy companies, you know, that seemed like a good place to be. And equity is at a high level. Now I think it's much more difficult to know what contrarian is. There is less of a clear trend and there is less of a clear positioning in the market.
You mentioned energy equities, which did incredibly well, which led the rally that we saw last year, and yet you have a complicated relationship with fossil fuels because it is your mandate not to invest in companies that have big carbon footprints. How have you managed a rally that a lot of people say will continue at a time when that kind of goes against some of your mandate?
Well, since the fund is based on revenues from oil and gas, the Parliament decided that we should not invest in pure upstream oil companies. So, what we do is to invest in the integrated energy companies, and I think that's a good place to be. They play a very, very important role in the energy transition, and so we continue to have big investments there.
Have you increased allocations on this wager that they're going to have an even bigger role as people realize that it will take fossil fuels to get to the other side that people think of as a cleaner energy future?
Just for the moment, we have pretty equal weight there.
Going forward, a lot of people are talking about a potential downturn in equities. We had Bob Prince of Bridgewater on yesterday talking about a potential 20% decline and an earnings bubble in stocks. Considering that you are such a big investor of public equities globally, how are you playing this? Do you agree with that assessment?
You know, I think it's the first time that I've seen such potentially very different outcomes. I mean, normally I have one strong view. Here I think there is a potential that the whole thing could muddle through. And the reason for that is because people are already so cautious. There is so much talk about recession. And typically, you know, the market wants to do one thing, it's to steal your money. And the way it could steal your money now is actually to go up. Having said that, I think the big uncertainty this year is what will happen with global inflation when China kicks in. I think it will be inflationary. And there is a risk that we could see an acceleration of inflation again on the back of that. That would be really bad for markets.
Well, what would be the diversification that could help from an investor standpoint in that scenario?
Well, so the problem in that kind of scenario, you're not going to make money anywhere. So, you know, if that happens, you will lose you will probably lose money in the bond market. You lose money in the equity market. You lose money in the real estate market.
So do you end up?
I just don't think there is any place to hide there.
What about cash? I mean, are you increasing some of your cash just to sort of be nimble in a situation like that?
No, we don't really. It's not really in our mandate to have a lot of cash. We are fully invested.
It's kind of a fraught moment then, if you think that everything could potentially do very badly.
Well, we are a very long-term investor. We invest with like a 40 to 100-year time horizon, and so we have to sit through some of this volatility. That's life.
A lot of people are talking about a sea change here in terms of the economy globally with the higher inflationary environment. Do you believe that inflation's going to be higher for longer, even after whatever downturn, whatever disruption, whatever inflation we might see this year?
Well, I think definitely there is a risk for that, right? So we had, with the global financial crisis, we had the biggest easing the world has seen. Then with COVID, you had the biggest stimuli we've ever seen. So you had like a world record on world record. And a lot of that froth has to be taken out. And that's not done in 10 minutes. So, you know, I think this could go on for quite some time. And just the reversal of the globalization could potentially add, I don't know, 1 percentage point to inflation. You know, it's more expensive to produce close to home.
And does that change your 60-40 or 70-30 in your case kind of view in terms of equities and bonds?
We are happy with 70-30.
Okay, so that's going to stick with it. When you talk about the equity allocation, there's a question about where the leadership's going to come from. Is it going to come from big tech, as we have seen in the U.S.? Is Apple still going to lead?
Well, it certainly hasn't led lately. I think it's very difficult to know what's going to lead this going forward.
Well, I guess then it raises a question: is it an indexing moment, or do you change your index? Do you change the concept of an index?
We run close to the index because the fund is so large that we have to do that. So we are not changing. We're not changing the index on the back of this.
Okay, so it's sort of whatever happens, it is what it is. So then, how do you affect change from a shareholder's perspective, and sort of get visibility if you're sort of subject to whatever happens in the global economy?
Well, I think that's exactly right. We are subject to what's happening in the global economy. There is not really any place we can hide. We have to take the long-term hat on and try to buy when other people are selling, and vice versa.
With respect to the allocation to less public assets, real estate, some of the private assets, do you think it is a time to increase that just as a hedge, or do you think that it's time to decrease that because some of the reckoning hasn't happened in that pocket yet?
Well, we have a great real estate portfolio with big holdings in London, New York, in many of the main cities around the world. We think it's a great part of the portfolio to have, in particular now. We are big in logistics. So we think to be, a big diversified player is the right thing to be.
So if you say that you basically track the market and you're subject to the market, then how do you get outperformance? What does outperformance mean to you at a time of potential losses everywhere?
Absolutely. So what we try to do is, of course, to get these excess returns. And since the fund is very large, you only need to tweak a tiny bit to get potentially big excess returns. And so what we've done over the last few years is to be overweight integrated energy companies. We have had shorter duration, i.e. we've had a portfolio on the bond side which has been less risky to rising interest rates. We've had some underweight equities. We were underweight some of the recent IPOs because we didn't think they were of particularly good quality. So those are the type of things we can do, and when you combine all these kind of things, you get potentially excess returns.
You talk about the bond portfolio. How are you tweaking it now in terms of long duration or short duration? Are you shifting it around in anticipation of a potential downturn, even if inflation in the near run is going to be?
No, we are not doing that. We are quite close to the index that we have on the bond side.
This is your first year at the Davos conference at the World Economic Forum.
Yep.
Why did you come this year?
We came because we have a very strong message. We think that the boards generally need to sharpen up. We think the boards need to be more on the ball when it comes to the climate, and we will increasingly vote against boards which don't have a particularly credible plan for reductions. We are vocal on executive pay. We think in particular in the US, the corporate greed has just gone too far. And we are also very strong on increased diversity at board levels. That's the main message we have this year.
How receptive are people to that message, particularly on executive pay at Davos?
Well, very much so. I do think companies really listen. We had some against votes last year, and following which the companies want to, have a deeper conversation with us, and we are seeing some effects in terms of different packages this year.
A lot of people are talking vocally about the importance of leaning into ESG and continuing to be to put an emphasis on it, and yet behind closed doors, people are investing that much more in fossil fuels. You have even Germany investing in coal once again in order to try to fortify the nation ahead of potentially a disruption in the energy system. Do you get any more pushback now than perhaps a year ago?
Well, there are a couple of things there. So what we're seeing in the energy market now is that in the short term, it's bad news for the climate because there is more coal production and so on. But longer term, I do think that the crisis we're seeing now will accelerate the move into renewable infrastructure and renewable energy. So I do think longer term there is a positive development. Now then you have the whole thing about backlash against ESG, and we think it's really, really seriously bad. We think that ESG, that is just not politics. It's common sense. And taken to the extreme, in an uninhabitable world, the value of our fund is zero, right? So it's clear that climate is important for financial assets.
The other issue that people are talking about at Davos is a bipolar world, this idea of the West versus China, and this question about rising tensions. Does that factor into any of your discussions with boards in terms of security issues in light of what happened with Russia, in light of the invasion of Ukraine? Is that also part of those kinds of ESG conversations?
I don't think it's part of ESG as such, and I think that's probably an area where boards are doing quite well, is to think about their supply chains and so on. But clearly a reversal of globalization is not great generally.
A lot of investors who I've been speaking with, and I want to wrap up here, just are obsessed with central banks and what they're going to do next, and whether they're going to raise by 25 basis points or 50 basis points. Do you track that? Is that something on your radar? Do you care about whether they drop too soon or they raise rates earlier? I mean, you have to care. But how do you factor that into what you do?
Well, it's the very big question for us. It's what will happen with rates around the world. There is a risk that they will stay high for longer. There is a risk that when China comes back in, it could reaccelerate. I mean, these are risks that we look at and that we have to take into consideration.
Do your traders trade every day?
We have a lot of rebalancing and trades. We got a lot of PMs, and so the answer is yes, we do trade every day. I don't trade personally. But hey.
But maybe we could go skiing. Nicolai Tangen of the Norwegian Sovereign Wealth Fund, who did not wear his Norwegian hat, much to my chagrin, for this interview. Back to you over in London, Tom.
Maybe next time. Fascinating conversation, Lisa. Thank you very much indeed. Particularly zeroed in on his comments around the inflation risk linked to China, and quite the line there on corporate greed in the US getting ahead of itself. It's gone too far, he said. Talking of China, we have had a meeting now between the US Treasury Secretary Janet Yellen, of course, and her counterpart in China, Liu He, who's on the ground in Zurich. And a couple of lines coming through. Yellen saying that she sees a pressing need for the US and China to closely communicate. Yellen saying that the US and China need to discuss macro and financial conditions. And from the Chinese side, then, the Chinese Vice Premier Liu He, who is charged with economics in that country, saying that they must manage both sides' US-China differences and maintain relations, saying that US-China must have serious macro climate coordination. Let's check in on the markets then. There's been some interesting moves, particularly within FX. You'll remember, of course, the Japanese yen falling like a stone at the start of the session. Those losses are paired to some extent. The yen now trading 129 versus the US dollar. That's a drop of 1.3% after the BOJ reiterated its conviction around yield curve control. Of course, for now, Venram of around 19 saying the BOJ is just kicking the can down the road. The euro as well, rallying up 0.4% at 108 on the back of comments from Villeroy, the Bank of France governor, saying that the 50 basis points guidance from Madame Lagarde is still valid. The pound also getting a bit, up 123, a gain of 0.4%. Yields higher on front-end German debt, the 2-year. There's plenty more coming up. Surveillance, early edition, is up next. The equity markets here in Europe gaining a little over 0.1%. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
News breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
But 1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here live from Davos at the World Economic Forum. Now, on today's show, we continue our live coverage and special guest interviews out of the WEF. In just a moment, we'll be speaking with Poland's Prime Minister, followed by the JP Morgan EMEA Chief Executive. And then later on, we'll also speak to Nigeria's Finance Minister, Zainab Ahmed. Now, on to the guest of the hour with this exclusive conversation from Davos, the Prime Minister of Poland, Mateusz Morawiecki. Thank you so much, Prime Minister, for joining us.
Thanks for having me.
I know you have a very busy schedule in Davos. I know a lot of the talk is, of course, about inflation. A lot of the talk is about the economy. We also have
Ukraine and
Russia. And we also have breaking news out of the IEA saying that the oil market is facing a bigger surplus even as China's reopening. Now, you have said that you will reduce your dependency on Russian oil, but you have not completely quit it. Can you quit it?
We can quit it. We have actually abandoned any imports of Russian gas and Russian coal. We've done this within a very short period of time. And together with the other member states of the European Union, we are going to do the same with oil. So making Europe independent of Russian fossil fuels, yes, and re-establishing distorted value chains, production chains post-COVID. These are the major economic challenges of the nowadays.
So, Prime Minister, given the energy complex now, can you cut off Russian supplies completely?
Yeah, we can do this. We've done this with gas.
But you are doing it?
Sorry?
Are you doing it?
We are doing this, and we are going to do this together with the other countries of the European Union, because this is what we have decided several months ago on our European Council meeting. The important thing is to do this together.
Just a couple of more headlines, of course, from that IEA saying that the oil market facing a bigger surplus even as China reopens. So welcome everyone who's listening on radio or who's watching on TV. We're with the Polish Prime Minister. Prime Minister, when you look at, I guess the energy complex going forward, and also you have talked very tough on Vladimir Putin because of his war in Ukraine. What are you expecting the EU to do next? Are you pushing for more sanctions package, a 10th sanctions package?
I am, because this is the only way how we can end this war in a peaceful and stabilizing manner. I just fear that Russia will be successful in their invasion, and then the whole of the European Union is in trouble. So the only peace which will mean stability for the future is when Ukraine survives, Ukraine's sovereign and territorial integrity is maintained. So this is why the sanction packages started to bite Russia. first couple of months you wouldn't see this, but now, right now, the Kremlin has to count with the sanctions packages, and we are going to work on the 10th sanction package right now.
How soon do you think we'll get that?
Over the next couple of weeks, I hope. There is a meeting between the EU and Ukraine the beginning of February, and thereafter we have a meeting within the European Council, and I think we'll be closing this in the month of February.
Prime Minister Bloomberg yesterday, our editor-in-chief, spoke exclusively to the Chancellor of Germany, Olaf Scholz, who said he's speaking to allies, to send some Leopard battle tanks to the ground. You have 14 of those tanks. Have you spoken to Germany, and will you send them?
I spoke to Olaf as well several weeks ago. I tried to encourage him and Germany to do more, because Germany, with their policy on dependency of gas, Russian gas, created lots of uncertainty and instability in the first place. So they should now feel more responsible to support Ukraine. Their policy back then was Wandel durch Handel, change through the trade. And now they should take bigger responsibility. They should help with weapon delivery to Ukraine even more. And I try to persuade Olaf to do so as quickly as possible.
But do you have their support to send your 14 tanks? Will those 14 tanks go?
As we said, we are making we earmarked our 14 Leopards tanks, and now we wait also for Leopards from Denmark, Finland, Germany, and tanks from the other countries of the European Union, because we wanted to inspire others to actually gather more tanks to have potentially 60, 70, up to 100 of very modern tanks, which can make a difference on the battlefield in Ukraine.
Prime Minister, how difficult is it to, of course, go very hard on Russia without making Vladimir Putin think that it's so bad that he would use nuclear weapons? Is this a serious threat?
I don't think so. Everybody has to count with this, of course, because nothing is beyond our imagination. But on the other hand, I don't think it will happen. Here, even China was very much on our side and saying to the Kremlin, to Putin, don't do that, because this would mean a completely different world. So I'm cautiously optimistic on this very critical aspect which you asked.
How difficult is it to keep Viktor Orban close, being friendly with Viktor Orban, given his stance on Russia?
It wasn't easy, but we managed. On all those sanctions packages, he could have blocked this because sanctions have to be agreed unanimously. And every now and again, I had to talk to Prime Minister Orban, to Viktor, and so far, whatever you say about Hungary, we are not happy with their position towards Ukraine, but he never blocked sanctions on Russia.
Prime Minister, you've also been locked in a dispute with the EU on the disbursements of these 35 billion, euros. How's that going? How's that progressing?
I think closer and closer. We are closing all the contentious topics, and I hope that over the next couple of months we will be there with our RRF, with the next gen EU. Right now we are doing fine even without it, because we have started all the projects related to RRF with our own money. Because of our very stable budgetary situation, we were able to not only gather money for RRF projects, but also I'm not sure if you're aware of this, but our expenditures on defense might be the highest in the NATO, in the whole of NATO.
Yes. You're also facing elections this year.
The highest in terms of GDP, comparison to GDP, of course.
But you're also facing elections this year. Later on this year, how difficult is it to continue with fiscal spending as we get closer to the elections?
Fiscal expenditures and stability of public debt and so on, these are not major challenges for Poland. I know they are for many of our partners, for other member states of the EU and other countries. This is because we managed to repair the public finances, and we spend more on military military expenditures, social expenditures, at the same time keeping budget deficit in check.
Prime Minister, how, I don't know if it's a concern or whether you're worried that there's too much optimism in Davos, that we spend maybe too much time talking about the US debt ceiling and maybe not enough on energy, the complex, and Ukraine here in Davos.
I don't hear too much optimism here in Davos. I realize that many people have fear of recession this year, potentially even beginning next year. Inflation, as you asked, critically important topic, and stability of supply chains post-COVID and so on, reestablishing those, nearshoring, near sourcing. These are the topics here in Davos. And I think Poland and Central Europe is very well located to be pivotal in this reestablished order of the business models of many Western companies.
Thank you so much, Prime Minister, for your time today. That was, of course, the Polish Prime Minister. He is Mateusz Morawiecki, and, of course, joining us for an exclusive conversation. Now, we'll have plenty more from Davos throughout the day. Some of our other guests speaking to us in Davos. Here they are. Stay with us to hear from the biggest names in global business, including the Blackstone CEO, Stephen Schwarzman, a little bit later this morning. Coming up, more interviews live from here. Don't miss our conversation with the JP Morgan EMEA Chief Executive, Viswas Raghavan. That's next, and this is Bloomberg.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos. It is a cold Davos. I know I got many messages on social media saying, how cold is it exactly? So I'll be a weather girl from time to time and telling you it is -9 Celsius. It is cold. Let's get to another great conversation here at the World Economic Forum. Joining me now is the JP Morgan EMEA Chief Executive Officer. He's Vis Raghavan, also braving, not the wind, but certainly the bitter cold. Vis, thank you so much for joining us, as ever. It's great being back in Davos with so many Wall Street banks being back, financiers gathering around, and we haven't been here for 3 years. What's the mood like? It's difficult to gauge whether it's too optimistic or too pessimistic.
Look, I think first of all, it's great to be back because it's been 3 years since we all got back together. So it's really good seeing people, clients again. The mood is mixed. I mean, it seems like a Davos where everyone admits we are in flux. There's clearly, we had some good signs on, inflation kind of finally, have you seen the end of it? Is there light at the end of the tunnel?
Yeah.
Is there a reversal coming? I think interest rates have all kind of gone up, so the era of abundant, cheap money is gone. Now finally there is a supply constraint, there's a cost of capital. So companies, treasurers are all reworking, the whole cost of capital model. But I would say, there is optimism, but, our base case as we plan for our year ahead is a modest recession, a mild one, but clearly, when you're a man on the street, it doesn't feel that way.
Yeah, it certainly doesn't. What does it mean for the bank? So when you look at compensation bonuses, and certain, parts of the business did great, others saw a bit more pressure. What kind of conversations are you having?
Last year wasn't great for, if I split the businesses between kind of investment banking and markets, the investment banking, we've talked about it before, it's been a pretty anemic year in terms of volumes, et cetera. So, and all the banks pay for performance. So if the performance isn't there, so the compensation isn't going to be there. On the market side, it's really been, selective depending on asset class. So commodities, rates, macro had good years. Credit, we've charted the course for some time, so credit has been very mixed. And then equities, volatility desks have really done well, whereas, you've seen little by way of conviction buying, so cash equities has been kind of more muted.
So in terms of compensation, and U.S., we think that U.S. bonuses will be down. Europe would be the same?
Absolutely. It's, the performance hasn't been there, so it's not even and people understand. This is kind of, if the performance isn't there, you don't expect it.
Yeah, so you don't worry about talent, retention or leaving ship or anything like that, because is it across the board?
No, I don't think so. And generally, where at times like this, when you're at JP Morgan, you have the flight to quality. What business is happening. We do end up partaking in a lot of the activity. But really, I think the pay-for-performance culture doesn't go away. So.
Talk to me a little bit about whether some of their staff needs to move around. I know you did a push, for example, into Paris, into France because of Brexit. Does that continue, or is it on halt?
I think we've attained our steady state as it relates to Brexit. We were very early, and so a lot of the moves that had to be done, they've happened, and it's nicely settled now. I think we have all the folks wherever we need it, and I think. It's working, pretty well. In terms of our investments, though, I think clearly, Chase International has been a big push for us. So we continue to hire in the UK. So in the UK, we still have about, in excess of 18,000 people. So it's still a lot of critical mass.
Is the UK stabilizing? So it's interesting to, not see the Prime Minister, not see the Chancellor here, but there is a shadow Chancellor. There is the shadow Prime Minister, the Labour leader.
Yeah. So look, I would say the UK is feeling the same kind of the economic kind of cross currents that pretty much every major nation, G7, even emerging markets, everyone is feeling the same cross currents. But there's a bit of a kind of a nuance in the UK, and I would say the nuances are clearly there is a kind of an economic Brexit impact which needs to be replenished, and that is work in progress. Unemployment is good, so the rate is low, at around 3.5%, but the workforce, the labor force participation rate is really low. And that's true of the United States as well. A big chunk of the workforce simply hasn't, returned to work. And I think that needs to improve. And then finally, I think it's fiscal policy. And actually, our equity strategists have the UK among their top picks, purely from a valuation point of view. So notwithstanding these little idiosyncrasies, if you take, there are some fantastic companies, multi-currency earners, sterling cost base, and I think there's real valuation upside there.
Does it feel better to be in the City of London? Because it feels like the Sunak government is trying to take care of the city a bit more with, for example, the stopping of ring fencing and things like that. Are they taking notice? Have you had meetings with them?
Yeah, we do, and I think the partnership between, government, treasury, the financial institutions, and the whole financial system, it's always been very, very good. Through the financial crisis, through COVID, it's very iterative. It's very hands-on, same with the regulators. I think they do a fabulous job. and they are kind of really managing within the constraints that are imposed on them. So, so in terms of activity, you do what you are able to do within the kind of the framework. So,
is working from home over?
Look, we have most of our people are back in the office. I think there's a spring in people's steps. I think it's really good having people back. So I'm not sure it's over, but I think the hybrid format every organization will discover their own kind of formula, and I think it'll bed in nicely. So,
Viz, thank you so much for coming on today. Yeah. Of course, that was the JP Morgan EMEA Chief Executive Officer, Viz Raghavan. We'll have plenty more, of course, throughout the day. Coming up, what does it mean to be contrarian when you have $1.3 trillion of investments? The Chief Executive of the Norwegian Wealth Fund, Nicolai Tangen, tells us. That interview is next, and this is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Chief Executive Officer of the Norwegian Wealth Fund, Nicolai Tangen, made an appearance here in Davos, and he told us he would like to send a message to the chief executives, encouraging them to avoid corporate greed. Now, Tangen told us what is changing in the fund's investment philosophy.
Contrarian, of course, means to try to do the opposite of everybody else, and that's where all the money is. I mean, if you are right in a contrarian way, you will do much, much better. And that's kind of the philosophy we try to install increasingly amongst our traders and our portfolio managers.
What does that mean in terms of specifics here? What is sort of the common thought that you would lean against?
Well, I thought it was much easier last year to be contrarian because it was clear that, with so much negative rates that there was one way they could go. A lot of people selling out of the integrated oil and energy companies. That seemed like a good place to be. Equity is at a high level. Now I think it's much more difficult to know what contrarian is. There is less of a clear trend, and there is less of a clear positioning in the market.
You mentioned energy equities, which did incredibly well, which led the rally that we saw last year, and yet you have a complicated relationship with fossil fuels because it is your mandate not to invest in companies that have big carbon footprints. How have you managed a rally that a lot of people say will continue at a time when that kind of goes against some of your mandate?
Well, since the fund is based on revenues from oil and gas, the Parliament decided that we should not invest in pure upstream oil companies. But what we do is to invest in the integrated energy companies, and I think that's a good place to be. They play a very, very important role in the energy transition. And so we continue to have big investments there.
Have you increased allocations on this wager that they're going to have an even bigger role as people realize that it will take fossil fuels to get to the other side that people think of as a cleaner energy future?
Just for the moment, we have pretty equal weight there.
Going forward, a lot of people are talking about a potential downturn in equities. We had Bob Prince of Bridgewater on yesterday talking about a potential 20% decline and an earnings bubble in stocks. Considering that you are such a big investor of public equities globally, how are you playing this? Do you agree with that assessment?
I think it's the first time that I've seen such potentially very different outcomes. I mean, normally I have one strong view. Here I think there is a potential that the whole thing could muddle through. And the reason for that is because people are already so cautious. There is so much talk about recession. And typically, the market wants to do one thing, it's to steal your money. And the way it could steal your money now is actually to go up. Having said that, I think the big uncertainty this year is what will happen with global inflation when China kicks in. I think it will be inflationary, and there is a risk that we could see an acceleration of inflation again on the back of that. That would be really bad for markets.
Well, what would be the diversification that could help from an investor standpoint in that scenario?
Well, so the problem in that kind of scenario, you're not going to make money anywhere. So, if that happens, you will lose you will probably lose money in the bond market. You lose money in the equity market. You lose money in the real estate market.
So do you
I just don't think there is any place to hide there.
What about cash? I mean, are you increasing some of your cash just to sort of be nimble in a situation like that?
No, we don't really. It's not really in our mandate to have a lot of cash. We are fully invested.
It's kind of a fraught moment then, if you think that everything could potentially do very badly.
Well, we are a very long-term investor. We invest with like a 40 to 100-year time horizon, and so we have to sit through some of this volatility. That's life.
A lot of the Norges Bank Investment Management Chief Executive Officer Nikolai Tengen. Now, coming up, the German Chancellor Olaf Scholz says he's confident his country can avoid a recession this year. We bring you that exclusive conversation next. This is Bloomberg.
Now they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos. Now, Olaf Scholz has offered reassurance that Europe's largest economy will avoid a recession despite facing an energy crunch amid Russia's war in Ukraine. Well, the German Chancellor sat down exclusively with our editor-in-chief, John Micklethwaite, in Berlin.
I'm absolutely convinced that this will not happen, that we are going into a recession, and we showed that we are able to react to a very difficult situation. I think no one really expected that we would easily survive a situation when there would be a complete stop of the supply of Russian gas to Germany and Europe. But we succeeded with all the decisions we took to fill our storage capacities with gas, that we put 20 coal plants back to work in producing electricity, in using the Norwegian and gas and the Dutch gas, and in using the capacities of Western European ports, and building new LNG ports at the northern shore of Germany. And the first one was opened in the end of last year after 200 days of work. The next one last week, and the third to come will be opened the next week.
But do you think, Chancellor, that that is enough for next year? Europe has avoided a gas crisis, an energy crisis this year, partly because of the provisions you talked about, partly because of the rather nice warm weather, although Berlin seems to be an exception at the moment. For all those reasons, we've got away with it this year. Next year, do you think that you can get through without blackouts? You're giving up nuclear power. You're giving up a lot of that gas that you had this year.
I'm sure that we will be able to go through the situation again. And this is because we are constantly increasing our capacities for importing gas from the northern German ports. And this will not stop with the things we did already. It will continue. And we will build a capacity that gives us a chance to have as much gas as we had before this war, and are able to import it without importing gas from Russia.
Well, that was the German Chancellor Olaf Scholz speaking exclusively to Bloomberg's editor-in-chief, John Micklethwaite, in Berlin. Now, later today, we'll also hear from the European Parliament President, Roberta Metsola, so don't miss that conversation. Of course, a huge one, not only on spending, Parliament, some of the scandals that we've seen in Brussels, but of course, a big conversation on Ukraine. Now, the business and financial elite are in Davos, here to discuss urgent global issues, and earlier we spoke to the State Street Chief Executive, Ron O'Hanley. He told me what his outlook is for 2023.
It's still early, I think, to say that it's all over.
I think that if you think about the United States, I mean, you still have a very, very tight labor market in most areas. That tends to provide inflationary pressure. You've got the situation in China with COVID, and we just don't know if that will result in any kind of production problems that will become inflationary. You've still got a lot of fiscal stimulus that's working its way through the system and will result in at least it'll have good impact, things like the Inflation Reduction Act, but in my mind, it's too early to be optimistic. And then lastly, and maybe most importantly, there's a lot of geopolitical risk out there. We just don't know what's going on in Ukraine yet in terms of what that outcome will be. And by the way, in the United States, the potential for a debt ceiling fight.
So first of all, how do you view the U.S. debt ceiling issue? Is this something that could turn ugly? If we talk about the 24th hour, could we go into the 25th? And could we even see a U.S. downgrade?
Yeah, the idea that we're even talking about this after what we've seen in the past, to me, is very disappointing. This is about money that we've already spent, money that we've already borrowed, and that we need to actually honor that. So this is not the way a political fight should occur. I think that markets have not priced it in. They don't typically do until it gets very close. But it would be catastrophic if this got pushed through to a actual we're not going to pay our bills.
Ron, we also had the keynote speech from the Vice Premier of China yesterday, and then a few select financiers got to meet him also privately. Were you given assurances that China is reopening in the right way?
So I think I'm actually optimistic about China. I think the Biden administration has done very good work with China. I think there's a recognition that while there could be some select decoupling, and there needs to be, if you think about chips and things like that, I mean, these are two major trading partners, and China is an important trading partner to the rest of the world. So some of the personnel moves that apparently have been made in China, I think, are strong signals. So again, it's far from over, and it's not the situation that we enjoyed back in the mid of the last decade. But I'm more optimistic about that from a geopolitical perspective.
Right. Well, that was the State Street Chief Executive Officer Ron O'Hanley speaking to me earlier. Coming up, we're live in Davos for the World Economic Forum. Don't miss Manus Cranny's interview with Nigeria's Finance Minister Zainab Ahmed. That's next, and this is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
it means they have a Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos. Now, we're just getting some breaking news from the Aramco chief executive who has arrived in Davos and is speaking to reporters. He's saying that there is spare capacity in the oil market, but that is too low. He also said demand is actually picking up on the China and aviation recovery. He was also, for example, discussing with our people here on the ground chemical investments with many Chinese firms. So on the one hand, opportunities because China's reopening, but I guess he says there's not much of an oil buffer because demand will pick up. This is what he's saying in China, and also aviation in general is picking up. So we have a lot more conversations to bring you today. The Manus Cranny is here with a guest, and you also talk oil. Manus.
Francine, yeah, interesting comments from Aramco, and that's spare capacity. Let's see, does that shift the oil markets? It's relevant to Nigeria, it's relevant to the budget, it's relevant to oil production. The finance minister knows a thing or two about squaring the numbers. It is Zainab Ahmed. She joins me now. Minister, welcome to Bloomberg. Welcome to Davos. Good morning.
Thank you for having me. Good morning.
Let's get to growth. The mood music has shifted a little bit more optimistic from the people that have sat in your seat. Nigeria is expected to grow by 3.75% this year. That's a bit ambitious, isn't it? What are you going to deliver in a tough year for 2023?
Well, for 2023, we're looking at a growth of 3.5%, and we're looking at closing 2022 around the same number as well. We're still waiting for our last quarter report to come out. Growth has slowed down a bit in the third quarter of 2022, and therefore we have had to moderate our year-end projections to reflect that decline.
What's going to drive 2023 for you? If you've had to moderate in the Q4, what drives this year forward?
What drives 2023 forward is increased revenues from the non-oil sector, and also the beginning of the pickup of revenues from the oil sector itself. I'm sure you know that we've had some problems regarding production, and but the production has picked up, and it looks good to continue to reach the numbers that we have put in the budget. So we hope.
So what do you think? What do you think Nigeria will produce in terms of oil this year? What's realistic? I know Melekari is going after the oil thieves. What can you deliver in terms of oil production?
Our target is 1.6 million barrels per day.
And that comfortably achieve that?
That we can comfortably achieve that. We're about 1.25, 1.3 now, average off. So we should be able to reach that, and hopefully we surpass that as well with the measures that have been put in place.
Look, you're in full electioneering mode, and the election is hot on our heels. Would you say your party has done enough to win re-election? Inflation, it's a global problem, but that's doubled. Growth has slowed to just an average of 1.1% from 2015 when you took over. You've done enough to convince the public to put you back in office?
We have done a lot. We've done a lot in terms of taking care of the people, increasing our infrastructure stock, holding the economy to grow on a consistent basis. Despite 2 recessions, we pulled out of recession quickly and set the country back on the path of growth. We've also done a lot in terms of being able to provide for our people at the time that people need help the most.
But the accusation back to that political narrative is that debt and debt sustainability is probably the single biggest issue. Nigeria is now spending 80% of its revenue on debt servicing last year. IMF reckons that's going to break 100%. That is not sustainable. You've not got a sustainable debt trajectory.
Well, 80% is not sustainable, and our plan is coming down to 60% in 2023. And how are we doing that? We're doing that by increasing revenues and by significantly reducing costs to enable us cope better.
But that's going to hit the real economy, isn't it? If you've got to pull costs out, that's going to hit the people on the ground, the very people you said you're defending.
There are some costs that we can pull back on that will not hit the economy, but there are some costs that we must sustain, such as provisions for education and health, as well as infrastructure.
So you would defend robustly that you're in a sustainable debt sustainability. I'm struggling with that.
We are sustainable in our debt trajectory. We have made our plans to make sure we're able to consistently service our debts And by the way, we're also exiting for a subsidy, which is a huge cost and part of the contributors to where we are in terms of the debt stock. So once we pull the fuel subsidy out, production of crude oil increases, and then we sustain the improvements we have put in place in terms of non-oil revenue, then we should be able to come down to 60% debt to revenue.
Does that open up the bond markets for you again? If I look at the yield movement, the current yields, are they low enough for you to consider a Eurobond issue this year?
Not 2023, no.
You're not in the bond market 2023?
No, not 2023.
What do yields need to get to for you to think, yes, we're back in power, I can get back to the bond market, international debt market?
If we're able to get back to the rates of early 2021, then we can consider going back to the bonds market. But then we are consistently monitoring the bond market. We're monitoring the performance of our bonds. So when it gets to that comfortable level, we'll explore it.
But liquidity, how big an issue is liquidity for you? Is it getting tough? Is it getting tight?
It is tough. It's an election year. It's also a year where we have planned a census in April. So those are two very large spends that we have early in the first quarter of this year.
Look, under President Buhari, the bill for running the country is at $50 billion. I want to deal with this in a couple of different ways. That, to many people, is something which is just very unsustainable. Are you talking to the World Bank, to the IMF, any multilateral agencies about any help or relief on your debt?
We have been able to get support from the World Bank, from the IMF. During the COVID, from the IMF, we got support of the SDRs. So we have 2 rounds of SDRs. That had helped us a great deal. And also,
is there more to come? Are you in active negotiations for more?
So there's this general negotiation about another round of SDRs. We are part of the group that is asking for that, and we do hope it comes because it will benefit all of the emerging economies as well as the low-income countries.
How close are you to a significant announcement on that from the multilaterals? Could it be before the election?
No, I don't think so. I don't think so. So we just want to wait and see what happens in the spring meetings.
If I look at the currency side, you know, we talk about liquidity being tight. So out of the bond market, a currency which has dropped by more than 10%. Many EM currencies have had the same tough time. Is it a deliberate move by the government to embolden that weakening of the currency?
Well, it is a plan of the Monetary Authority, and it was planned carefully and implemented. Most people even say slowly, but we are where we are, and of course, what happens to the US dollar affects us as well.
Of course.
Yeah.
And the dollar has come off from its peak. Is it time to dump those multiple exchange rates? I mean, it's cost you $144 billion between 2017 and 2021. Is it time to dump and run on the multiple exchange rates?
So right now we have one formal market, the NAFEX, where trading is done. And that is the rate that we use for official exchanges as well. So if I get any dollar inflows, that's where it is monetized as well. Any outflows I have is monetized also at that INE window. So we have only one window that is an official window.
I mentioned $50 billion, the story that we wrote yesterday under President Buhari. Now, many people talk about the Ways and Means advances from the central bank. Your government is now asking the National Assembly to convert that debt, and part of that debt, into a bond to be repaid over 40 years. The question, politically, I suppose, and from markets is that legal? And what do you say to the critics of that strategy?
It is legal.
It is legal.
And we couldn't do it earlier on because there was limitations as provided in the Fiscal Responsibility Act. But in the 2021 Finance Act, we actually made an amendment that is enabling us to do that now. We could have done this earlier.
But is it politically palatable to ask the country to pay this bill?
It is the necessary thing to do, and it is the right thing to do. We don't want to leave this for another administration to come and do. So what we have also is a situation where this will provide significant fiscal relief because it's bringing down the cost of servicing the Ways and Means very significantly.
Minister, unfortunately, I'll not be there for the election. One of my colleagues will. It's my one opportunity to get to Nigeria, so hopefully you will invite me across the rest of the year. Thank you for joining us on Bloomberg. That is the Minister of Finance, readying herself for the political campaign. Francine.
Great interview, Manus. Thank you so much, Manus Cranny. They're talking about Nigeria. Now, we'll have plenty more, of course, throughout the day here from Davos. Also, you can log on to LIV Go. You can watch a really stellar panel with Bloomberg's Jackie Simmons moderating the panel on banking in the eye of the storm. Now, speakers there, and you can see, of course, some of them, the UBS chairman, Colm Kelleher, Citi chief executive, Jane Fraser, Singapore senior minister, Tharman Shanmugaratnam, and the Central Bank of France governor, of course, François Villeroy de Gallo. Now, coming up, we have plenty more on interest rates. The ECB reportedly on course to slow rate hikes from March. The Bank of France governor thinks that could be unjustified speculation. We'll hear from that exclusive Davos interview next, and this is Bloomberg.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos. Now, we're just getting some breaking news out of Ukraine. We have two big pieces of news that we need to bring you. First of all, the Serbian leader is marking his distance from Putin, saying that Crimea is Ukraine's. Now, this is something that seems surprising to many, something that we need to monitor, whether there is, of course, a fault line where some allies that have been previously very close to Vladimir Putin are now either taking their distance or certainly not supporting him as much as he used to. The other big piece of news that happened just in the last 10 minutes is the Ukrainian interior minister has been killed in a helicopter crash. Now, for the moment, investigations are ongoing on the ground. We don't know whether this is foul play or not. We know that the interior minister and at least 17 others were killed when a helicopter crashed near a kindergarten, of course, just east of Kyiv. Now, we'll have plenty more on that throughout the day. Also, let's get to the Bloomberg Business Flash with Leanne Gerrans. Hi, Leanne.
Hi, Francine. China's top economic official says the world's second largest economy is on track to rebound this year to its pre-pandemic rate of growth. Speaking at the World Economic Forum in Davos, Vice Premier Li He said coronavirus infections have likely peaked following the lifting of most COVID curbs. The Chinese economy grew 3% in 2022 at the second slowest pace since the 1970s. Now, the UK remained the world's biggest exporter of financial services in the first year after Brexit, but the US, which is in second place, is now catching up. According to the lobby group, the City UK, the country's surplus from the sector was $87.2 billion in 2021, up about 8%. The surplus recorded by the US jumped from the previous year to more than $85 billion. Now, the Bank of Japan has doubled down on its stimulus defense, pushing back against speculation of policy change. The BOJ held its negative interest rate at minus 0.1% and 10-year bond yields around 0%, and said it would continue large-scale bond buying. Its updated forecast suggests officials still don't see inflation staying above 2% over the coming years. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Bloomberg has learned that ECB policymakers are starting to consider a slower pace of rate hikes after a likely 50 basis point increase in February. But the Banque de France governor, François Villeroy de Galhau, says it is premature to make specifics rate forecasts for March. Well, we spoke to him earlier for an exclusive interview.
Activity is more resilient than expected, and we should avoid recession this year, probably. And second, inflation will very probably peak in this semester, first on headline and then on core. But we must stay the course in our battle against inflation. I'm very clear about that. We will win this battle. Let me be extremely straightforward, Francine. We will bring inflation back towards 2% by the end of 24 or 25.
Now, Governor, so you believe basically we should reach the terminal rate by the summer and then hold. Is there a worry that if you go interest rates up too high after the summer that you overshoot it?
I don't think so. I cannot yet say where the terminal rate will be, but I think we should be there by summer. To put it in a nutshell, last year was about speed, the sprint. This year is more about a combination of level and duration. And it's very important also to say that afterwards, we will stay at this terminal rate as long as necessary to bring inflation back towards 2%.
Governor, yesterday we had a story by Bloomberg, a Bloomberg scoop, saying that some people in the Governing Council believe that there should be a 50 basis points rise in February and then down to 25. Is this the right way of looking at it?
I saw this story. Frankly, Francine, I was quite surprised. We said very clearly we will decide meeting by meeting. We are data-driven, so it's much too early to speculate about what we will do in March. Let me remind you of the words of President Lagarde at her last press conference in December. We should expect to raise rates at a pace of 50 basis points for a period of time. Well, these words are still valid today. But again, we are pragmatic.
So you've built a successful company,
but you might not want to run it for the next 10, 15, 20 years. Or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is like you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Moment news breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
Next shoe to drop is a decline. It has to be a decline in the economy, and in particular, a contraction in labor markets, because the core issue with inflation is wages.
We expect to see a mild recession, largely driven by the painfully persistent service inflation.
I'm absolutely convinced that this will not happen, that we are going into a recession, and we showed that we are able to react to a very difficult situation.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. No change from the BOJ, the Bank of Japan, that pushes back against market speculation that is changing policy. That's led to big drops in the yen and bond yields. You can count on the ECB continuing to raise interest rates in half-point steps. That's the word from the Bank of France chief, François Villeroy, a member of the Governing Council. And more big tech job cuts on the way. Microsoft is expected to target engineers today, while Amazon's cuts focus on retail and human resources. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And plenty of news still being created on the slopes of Davos then at the World Economic Forum, Kaylee. But overnight, the big market story coming really from Japan.
Yeah, that was absolutely true. Broadly, it was an up day in Asia, but far and away leading those gains was Japanese equities. The Nikkei 225 was up a substantial amount, about 2.5% after that BOJ decision, in which they did absolutely nothing, which defied market expectations. Traders really had been betting on even a further pivot from the Bank of Japan in regard to yield curve control, and yet Kuroda and the board maintained it. So you saw a big move in Japanese assets. Obviously, the move in Japanese stocks was driven in large part by the weakness of the Japanese yen. At one point in the overnight session, the yen was weaker against the US dollar by 2.7%. We have reversed some of that move, but still it's weaker by a full percentage point. Right now trading at 129.48. And then in the bond market, we saw that 10-year JGB yield, which of course is capped at 50 basis points by the Bank of Japan, dropping down to as low as 36 basis points. We did see some recovery off of the lows of the session, ultimately ending the day down by about 6.5 basis points, or about 46 basis points overall for that yield. So we didn't get the move from the Bank of Japan, any real policy pivot from the Bank of Japan today, Matt. The question is, when might it be coming, especially with Kuroda's term up in April?
Yeah, exactly. And how much more can they afford to be buying JGBs? Take a look at U.S. futures. We're looking at gains, but they're very muted gains after a tiny drop yesterday. In the cash trade, we were down to 39.90. So close to that 4,000 level, and it looks like if we get gains today, we could overcome that. The 10-year yield coming down a little bit, so offering less competition to stock yields, off 5 basis points to 349.59, so coming in under that 350 level. NYMEX crude has risen, and in fact, commodities across the board are rising on a weaker dollar, so right now 81.52. That's West Texas Intermediate, not Brent. So we start to really see a climb in commodities across the board. Gold, not to be left out, up about 0.25% right now, $1,913 a troy ounce. Anna, what do you see in Europe?
Yeah, a pretty mixed picture, pretty flat picture, waiting perhaps, Matt, for more clues from the Fed, more clues on the China reopening story and the earnings story. We're in limbo on those three, perhaps, and we wait to get more detail. Also, perhaps watching what's going on with those conversations taking place in Davos. The inflation narrative continues to develop, and we just got confirmation of the euro area final reading on December consumer prices, rising 9.2%. That's exactly in line with the preliminary number, the estimate of 9.2%. So no change, not much to see then on the European inflation front, except for the fact that 9% is still a very high level, of course, for inflation. We'll come to that in a moment. One stock specific to point out, ASM International, a Dutch chip-making business, not to be confused with the also Dutch ASML, which is the company that is much, much bigger and makes lithography machines, but it is a chip maker, and it has produced some numbers that the market seems to be digesting very positively, and some analysts saying this could set quite a positive tone for the sector, which has been hit by some disappointing earnings readings recently. Brent crude up by 1.25% to echo, Matt, what you were saying, moving steadily higher. $87 is where we trade on Brent crude. The market's live team talking about long positions being taken in that market. The pound at 123 is the handle there, up 0.5%. The CPI data out in the UK today, 10.5%. That's down from 10.7%, but in line with estimates, sent the pound a little higher, still underlining the double-digit inflation challenge that the central bank is facing. And 108 on the euro, on euro dollar, up another 0.7% after a drop yesterday. We'll get more details on this, but this after reporting by Bloomberg yesterday that we might see a step down from the ECB February into March. A little bit of pushback from the Bank of France governor today on that front, and so the euro goes higher, Matt.
All right, we'll continue to watch the ECB. Right now, though, I want to get more on the BOJ. Bank of Japan Governor Haruhiko Kuroda reiterated his view that the stimulus framework is not under threat. He also commented on the yield range.
There is no economic reason to expect the 10-year JGB yields to continue trading above the 0.5% band. I don't think the Bank of Japan needs to widen the 10-year JGB trading range, as the bank is continuing to manage market adjustments through the nimble use of YCC and fund supplying operations.
Bloomberg Kathleen Hayes joins us now live from Tokyo. So Kathleen, what are the key takeaways? Are they just going to keep buying bonds if the market pressures them?
Well, they're going to have to, aren't they? It's just interesting how one camp was so correct and one camp wasn't. Clearly the economists and other former policymakers, et cetera, said, no, this is not time for a change from the BOJ. They just did this YCC yield curve control adjustment 4 weeks ago. Why would Kuroda move again so soon? And it's just not likely, certainly not at this meeting, and maybe not before he steps down as governor of the Bank of Japan. Traders, though, and we can all sympathize, right? Hey, come on. When they did this adjustment, bond market went crazy. They've been forced to buy billions of bonds. A new record bond purchase is set every day, it seems. I'm exaggerating a bit there. But clearly, Governor Kuroda did not have that intention. He has not taken the first step toward normalization. And he made it clear in so many ways in their policy statement. It was reiterated at the press conference. They're going to continue large-scale bond buying. They're going to purchase bonds on a flexible basis as needed. They still don't see inflation in 2023 or 2024 getting up to 2% and staying there. So it's pretty clear that this was not the kind of first step, or at least the first step towards exiting YCC, starting to exit stimulus. And it seems that, if anything, another message, I think, is that this is what he's doing for now. He's kind of keep the boat going smoothly as he can, and if they're going, definitely they're going to have to buy more bonds. And do you think that's a problem for the Bank of Japan? Haven't they showed us, but now that they own more than half of the government bond market in Japan, that they'll buy bonds as they have to? They have, and they will continue as long as they have to.
Well, Kathleen, it begs the question then, if they're not moving now, what happens next realistically? When would that next move happen?
Well, first of all, I'd like to kind of put our focus on their loan provision program to commercial banks. They basically charge them nothing to borrow money that they can then use for other things, to buy securities like government bonds. You get a guaranteed return, and it's riskless. They've now said, Kuroda said at the press conference that he wouldn't rule out going negative, that rate going negative. That's how they determine they are to keep this steady. Next, governor. I think that's the story. We'll get the nominations in the first part of February. Governor Kuroda's last meeting is in early March. He steps down in April. The new governor's first meeting will be the end of April. That's what we're waiting for. I think this is all just, as I said, keeping things going, keeping the ship afloat, and the next person is going to have to take over. This will be big decisions and potentially disruptive when they do end yield curve control. Let the next guy do it. Kuroda's gotten the ball rolling in a way. It's up to the next team to carry it through.
All right, Kathleen, thanks very much. Bloomberg's Kathleen Hayes reporting live from Tokyo after the BOJ decision. Now on to the ECB, where policymakers are starting to consider a slower pace of rate hikes. But the ECB Governing Council member Francois Villeroy de Gallo says it is premature to make specific rate forecasts for March. Francine Lacroix spoke to him exclusively in Davos.
Let me remind you of the words of President Lagarde at her last press conference in December. We should expect to raise rates at a pace of 50 basis points for a period of time. Well, these words are still valid today. But again, we are pragmatic.
But Francine Lacroix joins us now from Davos. We cut you off there at your butt, Francine. It doesn't look like he was having it, right? He doesn't want to speculate on what's going to happen, 2 months out.
Yeah, he had one message when he came on Bloomberg, and it was, we're data dependent. It was funny. He actually sat down, Matt, and he said, just a reminder to everyone, I'm not a bird, I'm not a hawk, I'm not a dove, I'm data dependent. And from there started the conversation of how he saw it developing. He says it's absolutely too soon to commit to anything in March, but he says, go back to what Christine Lagarde said. We need to continue fighting inflation. And the way he sees it, first of all, he wouldn't be drawn on where markets were wrong or not, but actually you're aggressive, you're quite aggressive from now until the summer to make sure that you nip it and that inflation goes down, and then you pause. So there's no talk about an ECB pivot. There's no talk about possible rate cuts. This is, you need to do it strong. You need to do it now. Get to the terminal rate probably by the beginning of summer or midsummer, and then you kind of cruise through to give everyone a chance to recuperate. What's interesting, and is that he didn't give me a terminal rate. He says we just don't know where that is yet, so they're monitoring the situation.
Okay, Francine Lacroix in Davos, thank you very much. She'll be back later this hour, of course, with an interview with the Standard Chartered CEO, Bill Winters. Lots more coming from Davos this hour, in fact. Sticking with the macro themes, UK inflation dipped for the second month in December, falling further from a 40-year high. UK Chancellor Jeremy Hunt says he has more to do to bring down the cost of living.
Today's figures show is that there is no room for any deviation from our central objective of the year, which is to halve inflation so that we deal with the anger, for example, of public sector workers.
Bloomberg's UK reporter Lizzie Burden joins us now with details. And Lizzie, take us through the headlines, if you like, from the inflation print.
Well, so you're seeing inflation dropping for a second straight month. It's clearly on the downward trend. It's probably past the peak, but it's still 5 times the Bank of England's target, still in double digits. What's driving the fall is prices at the pump, but you still saw food prices increasing, actually at the fastest pace on record, and also services inflation on the rise again, because businesses are are passing on the cost of higher energy and higher labour costs. And we saw that in the jobs data yesterday, wages rising at the fastest pace, excluding the pandemic in November, but still not keeping pace with inflation. So on balance, the stickiness, the stubbornness of inflation is going to give ammunition to the hawks on the Monetary Policy Committee. Markets currently split between a 25 and 50 basis point move from the Bank of England in February, but economists increasingly changing their calls to a half-point hike. And as you heard there from the Chancellor, cutting inflation a key priority for the government because it keeps on fueling the strikes. But the bigger question for the Bank of England is how fast this decline will continue throughout 2023, and at what point, unlike the ECB, the Bank of England can pivot to cutting.
All right, Lizzie, thanks very much. Bloomberg's Lizzie Burden there, rounding up our macro headlines. Let's get to some company news now. Microsoft is joining the ranks of tech giants that are scaling back. Bloomberg has learned that the company plans to cut jobs in a number of engineering divisions today, and this comes as Amazon is also set to kick off a new round of deep job cuts. Alex Webb, a Bloomberg Quick Take, joins us now for more. So we continue to see these job cuts in tech. Microsoft looks like it's not so deep, but Amazon is going a little bit deeper.
Well, yeah, the Amazon is the job cuts that we already knew about. They are kicking off today. The job cuts at Amazon are, as you say, a lot deeper than those at Microsoft. We don't have hard numbers on the Microsoft numbers yet. It's from reporting from our colleague Dina Bass in Seattle. The thing is, if you look at the stats, Microsoft doesn't have the need to cut headcount quite as drastically as Amazon might. Amazon's revenue per employee, which is the number you get if you take the total revenue and you divide it by the number of employees, it's quite a good metric for how efficiently the company is run. Its revenue per employee has declined quite considerably compared to the number pre-pandemic. Microsoft, its number, revenue per employee, is still above that number pre-pandemic. It's dipped a little bit in the past few months. So it's maybe doing a little bit more fine-tuning around the edges rather than Amazon's deep and relatively hard cuts, at least for a company of its history.
All right, Bloomberg Quick Takes, Alex Webb, thank you so much. Now we'll look at some other company stories we are following this morning with stocks moving in pre-market trading here in the U.S. United Airlines, one of them. It is guiding for the first quarter earnings to be more than double what analysts expected. United saying between 50 cents and $1 a share. Analysts were only expecting about 22 cents. So that's a pretty big blowout, and it is all about pricing power because demand is still strong and supply is still constrained. So that stock is up about 3% before the bell. Another stock moving higher is Moderna. It released the final stage study for its RSV vaccine yesterday. It prevented more than 80% of cases. So that paves the way for the company to get its first approval outside of COVID-19 related products. So that stock is up nearly 6% before the bell. And finally, one more stock moving to the upside. This is earnings-related Interactive Brokers. It reported after the bell yesterday, topped expectations, the stock getting a reward as a result. It's up about 3% in early hours, Anna.
Kaylee, coming up on the program, a host of interviews from Davos this hour. We'll be speaking to the Bain Capital co-chairman, Steve Pagliuca. We'll also have the Standard Chartered CEO, Bill Winters, and Blackstone CEO, Steven Schwartzman, with us. Plus, German Chancellor Olaf Scholz thinks a trade war with the US is unlikely. Look for our exclusive interview online or on the Bloomberg terminal.
I'm sure it will not happen. We are working very hard to avoid a situation like this. And yes, we are very much appreciating what is the basis of the decisions of President Biden and the Congress saying that they are willing to invest into a better future, which is more looking for environment, developing climate-friendly industries, which I very much support.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons in New York, Anna Edwards with us out of London. But we want to get back to the World Economic Forum in Davos. Bloomberg's Lisa Abramowitz is there with Bain Capital co-chairman Steve Pagliuca.
Thank you so much, Matt. I'm Steve Pagliuca here with us after 34 years at Bain Capital, co-chair. You went there as you looked for some cash to subsidize your business school and never looked back. What are you doing now? What are you going to do now that you're going to retire? You're stepping down.
That's a great question. It's been only a day now, so maybe you can, give me some counseling. No, I think things will remain, for the short term, pretty much the same because there's a lot of projects to wrap up. I'll become a senior advisor to the firm, and I'm just so thankful to be with such a great group of partners for so long a time. I'm overwhelmed by it. Fantastic. I've been working with the same folks for close to 34, 5 years now.
When you look back at more than 3 decades, is there a deal that you maybe passed up that you kind of regret that you wish you had hooked into?
You know, I always believe you kind of can't look back. You always look forward. Maybe I should have bought some Bitcoin. I never got into that, but that turned out to be a good thing recently. But that had a great run.
And one thing, Adam Silver, the chair of the NBA, said that he doesn't believe that you ever will retire, that you are not somebody who will ever stop moving or working, and that you send him messages at all times of the night with suggestions. You do own the Boston Celtics. You are interested in the Chelsea football team. Didn't win that bid. Are you looking to push further into the football arena?
Absolutely. Football is a fantastic sport. You know, there's been a whole sea change in sports in general, which we benefited from, in that it's gone global. And the 2 global games are basketball and soccer/football. And as you know, we purchased Atalanta up in Bergamo, not so far from here in the mountains. And I was fortunate. I was able to go Sunday before I came here to the game, and we won 8-2. It's the most goals that Atalanta has ever scored in the history of the franchise. So it's been a really good week.
So maybe it was, your presence. I am wondering.
I don't think so. I think it's because we have good players and great coaches and great managers. But
in London, are you planning on bidding on any additional teams?
You know, I'd have to kill myself if I told you that answer. But yeah, our group is looking at many teams. The prices have gone up very high, and we want to buy a great club, but we want to stay disciplined so we can invest in the club over the future. And so my fear is some of these prices are now getting so high that there might be disinvestment, and I want to have a great club, and I want the club to be able to win, and you got to be competitive. So you have to budget putting money in to make it competitive.
You're leaving behind private equity, or you're not leaving behind private equity, because you're not actually leaving, because you're going to be an advisor to the firm for the next decade or potentially more. But you're transitioning in a real moment of transition for private equity. Do you think that we've already seen the peak for private equity, as perhaps we've seen the end of low rates and that entire era?
On the first question, absolutely not. Private equity is only in the first stages right now. I got into it in the late 80s, and it was a cottage industry. It was mainly located in the U.S. Didn't even have to travel that much, and there were very few firms doing it. By the way, I don't think there were even cell phones back then. So it was a whole new world. But what's happened is, and by the way, the reputation the industry got was they would buy overcosted companies and take costs out. That was in the 70s. By the time I got there, there was competition, and now there's lots of competition. So the real focus of private equity is to build and grow great companies. People want companies that are going to grow. So I think we live in a world where people think to the old days when it started. Private equity today has developed huge value-added global services, has taken companies and lifted them and transitioned them into becoming great companies. And that's how you really build and actually make money for your investors.
So what kind of victimhood or carnage do you expect to see from the fact that a lot of people think that we haven't seen the reckoning in private equity prices from what we've seen in public markets, that we haven't seen the reckoning of what the true value is for a company that grew up during 0% rates that now is facing 4 or 5%?
Well, that's a great question, Lisa. And I think the reckoning, the good news is the reckoning is going to be more of reckoning on tech companies and let's say, kind of new internet tech companies that people were saying, this thing, the Amazon model worked. We lost money for 20 years and all of a sudden we made money. Now that's the exception that proves the rule. And so the companies, the private equity firms that went heavily in that direction, paying 30, 40 times revenues, which was astounding me. That's where you're going to find the reckoning. But the rest of the portfolio is pretty well. The United States has low unemployment, so people are employed. People are spending money. So we're not seeing a diminution in those kind of speculative tech companies. And thankfully, Bain Capital, we haven't done very many of those.
But do you expect returns to come down because people are more disciplined with their cash and aren't necessarily as willing to go into high-risk moonshot investments?
That's a relative question. If you look at private equity returns, most firms are shooting for 18, 20% rate of returns. And when one of your compadres asked me this question in 1993, saying, I answered this question in 93, 2003, 2013, and now 2023, basically they say, there's too much money in 93, too much money. The industry has gone 10 times up in money chasing too few deals. You can't maintain those returns. Well, we've maintained those returns now for every decade for 40 years. Why is that? It's because the private equity model works. It puts capital to work with experts that really help drive these companies. And certainly Bain Capital, we were built to help companies. We came out of a consulting firm. We didn't come out of a finance firm. We came out of a consulting firm. And we spent 30 years refining that, having expertise in vertical markets, medical, technology, financial services. And so we add that value to the companies. We invest heavily ourselves in the companies. Our firm has like 10%, $1 billion in our $1.2 billion in our $12 billion fund. We invest behind the companies. So that aligned model, a long-term approach, and then value added both on vertical markets and now functional expertise. We bring in a digital marketing team. We bring in a finance team. Has made it a very viable model, and you're seeing it taking share from the public markets. So I think we're only still in the early innings, and it has another 20 to 50 years to run because it's a great business model. And
you can see it being 18 to 20% in that period of time as well.
Absolutely. It's consistently done that for 40 years now.
What about in China? What about some of these other areas that a lot of people are pushing into and seeing a lot of value? Is Bain as well?
Well, we've had a fantastic Asian presence for a long time now. We were one of the first people into Japan, for example. So we have a Pan-Asia fund. We now have over 50 people, professionals in Japan, I think the largest operation in Japan. And Japan's a fantastic market because they are now embracing capitalism. I met with the Prime Minister about a month ago. He's pushing that. They've got to rejuvenate the economy. They believe they got to have more free markets and more capitalism. And we've been fortunate because the Japanese really respect the company that's trying to build value and sticks with Japan. So we never went in and out. We went to Asia. We stayed there. We built a large presence. They love the value-added approach. So we've done large transactions like Kyokusha was Toshiba Memory, Hitachi Metals, and you're seeing the market open up there. And I was just actually on it.
Okay, just 10 seconds, 20 seconds. Do you think that they're going to drop yield curve control? Do you think that will be actually beneficial for bringing in investments?
Things don't happen quickly in Japan normally. And my father ran a company there in 1973. And I tell them, you've got to go from a 1,000-year time frame to 100, and then maybe we can get to 10. So I'm not optimistic that will happen. And they have a heavily indebted economy, so interest rates really hurt the government thing there. So it'll be a slow rise, I think.
Steve Pagliuca, I wish we could have more time. Steve Pagliuca, congratulations on your tenure and on the next chapter ahead, which will be, I'm sure, very busy. Back to you, Anna.
Thanks very much, Lisa Abramowitz there with Steve Pagliuca in Davos. Coming up, we will head back to Davos. We'll be speaking to the Standard Chartered CEO, Bill Winters. Lots more to come from the Davos World Economic Forum. Coming up shortly. This is Bloomberg.
invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price-wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. No change from the BOJ. The Bank of Japan pushes back against market speculation that it's changing policy. That's led to big drops in the yen and bond yields. You can count on the ECB continuing to raise interest rates in half-point steps. That's the view from the Bank of France, the governor speaking to Bloomberg. And more big tech job cuts on the way. Microsoft is expected to target engineers today, while Amazon's cuts focus on retail and human resources. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons over in New York. And Matt, I'm not sure if everyone's just watching our coverage from Davos or they're watching the tennis in Australia, but European equity markets a little directionless this morning, and US futures not much better.
Thank you for reminding me about the tennis. I will definitely tune into that as soon as possible. In terms of markets, there is nothing going on in futures. We were down 0.2% in the cash trade yesterday, and now futures are unchanged. So it does look like the markets are waiting for something to decide direction. If it were the bond markets, that would be a positive move because investors are pushing the yield down more than 6 basis points right now. 348.67 is the level on the 10-year, and that provides less competition to the S&P yield or whatever index you're buying. NYMEX crude is moving. There's a lot of action in commodities. This on the second day of rallies after the call that we got over the weekend out of Jeff Curry saying that, China reopening, avoiding recession in Europe, and central banks slowing down with rate rises is great news for commodities. This is WTI at 81.55, not Brent, so it's really gotten high above that $80 level. And gold continues to climb over 1,900. Right now, 1,912, only a small gain, 0.2%. But as the dollar weakens, these commodities are worth more. Kaylee, what do you see in terms of pre-market movers?
Well, one of the big ones to focus on this morning, Matt, is United Airlines, which gave preliminary results for the first quarter and full year, giving that guidance after the bell yesterday, handily topped analyst expectations. For that fiscal first quarter, analysts were expecting profit of about 22 cents a share. United comes out and says, no, it's actually going to be more than double that, between 50 cents a share and $1 a share. So that stock is up about 2.7%. This is really still a pricing power story because capacity remains constrained. Yes, United says they are expecting to expand capacity this year, but still supply is coming up a bit short of demand that remains really strong in the aviation space. So that allows the airlines to keep raising fares, unfortunately, for all of us that have a lot of flying to do. And as a result, you're seeing some trickle through to other airline peers as well. Not gaining as much as United, but American is up about 1.5%, while Delta Airlines is up by about a percentage point. Finally, one big outperformer as well to note today is Moderna, a stock we all know very well because of its COVID-19 vaccine. But of course, this company is trying to create a future for itself beyond that. And the latest product that it is attempting to do so with is its vaccine candidate for RSV. It released the final stage study results for that candidate yesterday. Highly successful. It prevented infection in more than 80% of those included in that study. So as a result, that stock is up about 6% before the bell, Anna.
Kaylee, European equity markets then just up 0.1%, so lacking direction, as I say, but either side of the flat line really on European stocks this morning. ASM International, the smaller tech business compared to ASML in the Netherlands, both Dutch, both operating in the tech space. This is the smaller one, but it did come out with some numbers today that pleased the market, up by 9%, and some of the analysts talking about how this could set a more positive, different tone for semiconductor manufacturers. So watch that one stateside. The pound at 123.44. Yes, the inflation print in the UK came down from 10.7 to 10.5, but that's still double digits. It wasn't below estimate, and so perhaps continuing to pile pressure after the wages data yesterday on the Bank of England, and so the pound is higher. The euro at 108.60. Yesterday, the euro fell. Expectation that perhaps we get a step down in the pace of hikes from the ECB. Today, the story is different. Pushback against that narrative from the ECB, Kaylee.
All right, well, of course, we had that ECB interview at the World Economic Forum in Davos. So let's go back now to another newsmaking interview. Bloomberg's Francine Lacqua is standing by with the Standard Chartered CEO, Bill Winters. Francine.
Yeah, thank you so much, Kaylee. I am delighted to be joined by Bill Winters here of Standard Chartered. Bill, thank you so much for joining us. How's business? Pretty good?
Business is good. Business is good. I cannot complain.
Okay, you cannot complain, but are you up for sale?
That's an impolite question. Of course not.
What should I ask you politely? There's been an offer for you.
No,
now everything at play.
There's not been an offer. There was, I think your colleagues wrote a story that there were some sources that said that bank may have been interested in us. The bank immediately put a statement out saying that they were not looking at Standard Chartered. That's as much as I know about it, truth be told.
Okay.
No, this is not something that we've either engaged with or been interested in. The thing with Standard Chartered is we're actually doing very well all by ourselves. Yeah. So it's been a bit of a journey to get our bank to where we want it to be. COVID was a pretty material distraction for the business. Obviously, it was a huge distraction for the world. And but everything is on track for us. We had super strong income growth last year. We had very manageable credit costs. Yeah. We've been returning capital to shareholders.
But Bill, consolidation is in play, right? Is that at the back of the mind?
It should be.
On how you run the bank or not?
No, it's not. We're running the bank to maximize value for a lot of reasons. One is that's the only way to run a business. But second is it's really hard to buy a bank. Right? There's especially a bank like us. A lot of regulatory approval is required. It's quite complicated. But but thematically, there should be an element of consolidation. But banks are a let's call it a protected species by regulators, and consolidation is hard.
So, if you think that actually now is the right time to do some kind of consolidation, what's holding it back? Is it regulators, or is it just the appetite? Valuations are cheap.
Some valuations are cheap. So, I mean, I think it's quite logical that banks in locations that are trading at a multiple of book value would be interested in consolidating with banks that are trading at a discount to book value. So, European banks are broadly trading at or below book value. Middle Eastern banks are trading at a significant premium to book value. So, just from a financial math perspective, yeah, everybody should be looking at this and saying, oh yeah, if you go back to the classroom and do the combination and then cost synergies and whatever, you make some money. But unfortunately, it's not that straightforward.
What's your take on China reopening? How smoothly is it going to go, and what does it mean for business?
Look, it's obviously been very sudden, and the impact has been dramatic in the short term. But country seems to be managing. The health system is highly stressed for sure, but isn't overrun. We've had virtually all of our colleagues, my colleagues, have been infected in the last 2 months. I mean, 90% or something like that. They've all recovered, so touching wood, and very grateful for that. And they're fully back to business. So I think we're really looking forward to a good renaissance in China, not just in the second half, but even in the second quarter.
So what does that mean, first of all, for the world economy, and therefore for some of, the IPOs or some of the deals that you have in the pipeline?
I think it means a gradual working out of the supply chain constraints that we've had. So we know that a lot of things have contributed to the supply chain problems, including geopolitical tensions and the like. But China's manufacturing challenges were part of that. That eases, which I think will be a good thing for the disinflationary impulse as well, which is obviously gathering a little bit of steam. Now, we'll have a separate discussion on inflation. I don't think we've quite beat it yet. So there's some more interest rate hikes to go. But China there'll be a big demand pull for China, so there's pent-up consumer demand. They'll re-engage in international travel, probably more in the second half of the year. This is going to be a good boost for the global economy at a time when the U.S. and Europe are probably going to slow down.
Are you surprised? I mean, there's a lot of leverage. There has been a lot of leverage for a long time in the system, and interest rates have moved up quite aggressively in the last 12 months, and we haven't really seen, either big bankruptcies or zombie companies.
As I reflect on this, I know what you mean by a lot of leverage, because aggregate debt levels have gone up a lot.
Yes.
But it's really very concentrated in governments. And the corporate sector is actually in very good shape, and the financial sector is in extremely good shape.
Yeah.
So banks have probably never been as strong as they are right now. And this is the reminder that the credit cycle never dies. But when you have a downturn in the credit cycle and the banking system is strong, you ride through it. And when you have a downturn in the credit cycle, like we did in 2007, and the banking system is weak, it's exponential in terms of impact. So I'm actually very optimistic that we can ride through this. Of course, it's difficult. And cost of living was very difficult. The inevitable slowdown in the U.S. and Europe already happening is very difficult. But we'll get through it.
But we're hearing also a lot of cost cuts, bonus cuts, compensation cuts, even job losses in banking. Is this just a clearing of
I think
last 2 years?
that's very specific to the investment banking deal business. So, which we have, but in relatively small size. The financial markets or fixed income business is booming. That's been a real strong source of growth for the U.S. banks and also for us. Retail banking is very strong. So customer delinquencies are actually low. We've come through the COVID period in good shape. The wealth management products are obviously a very slow sell with such weak equity and bond markets. But we're now at very attractive levels for investors to re-engage. I mean, equity markets have repriced. Bond markets, is it going to get a little bit better or worse? I mean, we're obviously moving around, but we're in a range now. And for the first time, you could look at a balanced portfolio and say, oof, yeah, I'm getting some return on my bond portfolio. I can expect some returns on my equity portfolio. It actually feels pretty good. So I'm very optimistic for the next year or two, even if right now we're definitely at the bottom of the trough.
All right, Bill, thank you so much for your time on Bloomberg here in Davos. That was, of course, Bill Winters of Standard Chartered. With that, and I'm going to send it back to you in London, and we'll have plenty more throughout the day.
Francine, thanks very much. Francine Lacroix with Bill Winters in Davos, ending that conversation with a little bit of optimism. Not much to say when it comes to the speculation about takeover for his business. When we come back, we will move on. Sticking with Davos, though, we'll speak with the Blackstone CEO, Steve Schwarzman. That's up next. This is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, there's 100 companies, Breakthrough Energy's funded. There's
by mitigation, you mean mostly energy. You mean everything to do with energy. You mean
generation of energy, you mean batteries, you mean transport, you mean all of the new, and there's some renewables that are already traditional, but more that need to come out. So that's the package that you're talking about mitigation?
Yeah.
Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Let's go, though, to Davos, back to Davos, to the World Economic Forum. Wall Street Week anchor David Weston is there with the Blackstone CEO, Steve Schwarzman. David.
Thank you so much, Anna. Yes, Wall Street Week is here because Global Wall Street here, and you know it is if Steve Schwarzman's here. So thank you so much for being with us, Steve.
Well, it's great to be with you, David.
So I think what many Bloomberg audience members would like to know is, what is your larger take? We're in Davos. We're taking a longer look. What is your larger take of what's going on with the economy in the United States and globally?
Well, I think in the United States, we're obviously fighting higher interest rates, but we're doing it from the perspective of an economy that's in quite good shape. One of the reasons for that is an outcome of the pandemic. And during the pandemic, people stayed at home. What every country's government didn't figure out is the 90% who kept being employed would end up having way more money after the pandemic because their cost structure collapsed. They didn't go to movies, they didn't leave their homes, they didn't travel, they didn't buy expensive clothes, and that $2.5 trillion of extra money was in the banking system, and they've been spending that money. And that's been keeping the economy performing better than people expected. They've spent about half of it. Whether they spend the rest of it, whether they save it, but that's an extra stimulus, if you will, that's kept the U.S. economy moving ahead pretty well. The Fed, of course, is trying to do something with inflation, and they have to, assuming they really want to get it all the way down to 2%. So they've been very aggressive, moving, and the question is, how much effect does that have? We're starting to see the economy slow down a little, and particularly in interest-sensitive areas. One would think it would have had more impact, but it hasn't yet. And the reason we've developed almost a two-part economy. Interest-sensitive areas like housing, where new house construction is down 19%. Usually in a recession, it goes down 35%. So you can see how far we are away from the bottom. It's affected Wall Street and markets because when you raise interest rates very high from a percentage of where you started, it'll have adverse incomes. And there are other parts of the economy that frankly are still extremely strong, that raising interest rates hasn't affected yet. Stuff like travel. Airlines just can't even cope with the volumes. Resort hotels. People after the pandemic were so grateful that nothing worse happened to them, that they just want to celebrate and live life. And anything that touches that kind of personal consumption is doing extremely well, not really affected very much by the Fed.
How does this affect the Blackstone outlook? I mean, you have an awful lot of money that you need to put at work and keep it working, get returns on. How does a slowing growth pattern and higher rates inform your investments? For example, I know you're very big in real estate.
Well, we saw this coming, actually, and started talking publicly about 18 months ago, way before the Fed, about high levels of inflation, because we could see it in our portfolio companies. And what we did is we tried to change what we do to adapt to what we were pretty certain was going to happen in the future. So, for example, in terms of an investment area, in the credit space, we switched all of our investments to floating rate. So we're on the side of the Fed. As they keep raising rates, our customers keep making more and more money. And they can get up into double digits now with senior secured loans. That's what people used to earn for equities. And it's pretty easy to do that now. In real estate, we've concentrated in basically the only two areas that aren't being adversely affected. Real estate's an industry with at least 6 different sub-areas. If you're in office buildings, particularly in the United States, that is an area under enormous stress. 20% vacancies, but that doesn't even count the people who aren't going to work. So that's an area that is facing real headwinds. And shopping malls, not so wonderful for a variety of reasons, basically with home shopping. Houses are going down now, okay, in value because mortgage costs have doubled for regular people. But areas that are doing extremely well, first of all, is warehouses. We're the largest private owner of warehouses in the world. And that business is fighting all the trends. It's up double digits, even in the face of the Fed. And apartments, rentals are also doing well. They come down a bit. They're going up somewhere around 5% now. But there's other types of residential rentals that are going up to about 9%. So at a time, there are some parts of real estate are really suffering. And people say, you're in real estate. We're actually the biggest in the world in real estate. Something bad must be happening to you. Well, if you really concentrate your ownership in the 2 good areas, then, you know, we're having just a fine time in that real estate area.
Stephen, what are some of the external factors that actually could affect things? Right now, there's a lot of talk about the debt ceiling and a lot of threats about maybe really tripping that. People think it's unimaginable. Maybe it is imaginable. You've been through this quite a few times. There have been a lot of threats of it. Some people think maybe the Congress is a little more extreme in some respects than has been in the past. What do you think is the danger of actually going into default or coming very close to it? And if it were to happen, how catastrophic would it be?
Well, I can't speak to the political dimension because the House has just formed, and we watched it on television, and it didn't look real functional on the Republican side. How that will play out, I really don't know. The history has been people use the debt ceiling to make a point, and the point from the Republican side is that we're spending too much money, and they want to make sure that their colleagues on the Democratic side understand that. In actual default, we've been through this a number of times where it's gotten quite close, and it's got a variety of really bad effects, and particularly with the dollar being the reserve currency of the world, which gives us a special status. It allows us to issue debt when other people can't.
You mentioned what the political disunity, if I can call that, in the Republican Party, and you're not a politician, you don't involve that. At the same time, as I recall, you did support Donald Trump early on. Where is the leadership of the Republican Party right now, and where should it be from your point of view?
Well, I said publicly, as to the next presidential election, that I think we need to move on for both parties. It's a next generation of leaders. I think it's important that, you know, particularly on the Republican side, we've had a series of 4 losses in a row: the 2018 midterms, the presidential in 2020, the special Georgia election, which actually was in 2021, the midterms in 2022. I think the public has spoken and would like to see a change. There are lots of interesting people.
Anybody you like in particular?
I always like somebody in particular, but you don't know if anybody's running at the moment. Nobody's declared except the president, and so, you know, I think we wait and see on that one. But you know, there's always interesting people, and you know, I in my life, you know, people barely had heard of Bill Clinton. Yeah. He became president. Yeah. The same with Barack Obama. Yeah. And so those were all 2 years out where we are now. Yeah. And so I'm a patient person. You know, experience has taught me that watching how things develop, because there's so much change in America, is an important thing.
Well, that patience just stood you in good stead, I must say. Thank you so much, Steve Schwartzman of Blackstone, for joining us here in Davos on Wall Street Week. And back to you, Matt Miller.
Thanks very much, David. Wall Street Week anchor David Weston there with Steven Schwartzman in Davos. Now let's get back to the markets right now with a focus on calls. Marko Kolanovic from JP Morgan, who had for so long been bullish, has stepped down his expectation for equities once again. The question is, will we see back-to-back annual losses? They're so rare, as you can see from this chart. If you're listening on radio, I will tell you that it's only happened in a couple of instances over the past 20 years. And of course, we had a big loss last year. So what does that mean for 2023? Joining us now is Nora Melinda, Bloomberg equities reporter here on set. So Nora, what do you think about the new Kolanovic call? He'd already sort of changed his stance after last year's horrible performance, but now he's saying avoid or take profits if you have any in Europe and in U.S. equities.
I mean, yeah, that's really what he's saying. I mean, he said that he sees downside risk for equities within this first quarter, and in general, I know we all know that he sees a potential recession, the U.S. falling into a potential recession by the end of 2023, and really just looking at in the Euro space as well. He's pretty much underweight there and overweight in emerging markets and China equities. So it's really interesting here.
Well, especially when we compare what drove the downside in 2022 to what potentially could drive it here in 2023, because it was all about the Fed last year. As we are about to enter the quiet period in about a week, is it as much about the Fed this time around?
Yeah, I mean, of course we had CPI data earlier this month, but we do have PPI coming out later this morning around 8:30, and then GDP to follow next Thursday. And I think in regards to GDP, it'll be really interesting to look at the growth aspect of things, because of course the Fed does want to tame growth. So if we do see significant growth within GDP next week, I think that'll kind of be a little bit of a sign for us as to what the Fed could be thinking. But that's what everyone's really analyzing and focusing on in these next couple weeks.
Nora, back to stocks. We've had a really strong start to the year, haven't we, for global stocks in particular, certainly outside the United States doing better than within it. What do analysts expect to see? We're heading into earnings season, of course.
Yeah, so this week, it could be potentially poor performance, and that actually would not be super different from what history has shown. Actually, BTIG has done a study, and data has shown that pretty much since 1928, in years that ended at least 10% down, which of course we ended further down last year. And in the following year, if the first 2 weeks we do see a rally, that third week, actually we tend to give back some of those gains. So if that is something that we do end up seeing this week, it would not be anything different than what history has shown us in the past.
Nora, thank you very much. Bloomberg's Nora Melinda with the latest on the markets. And Kaylee, when we came in this morning, the yen was down by 2.5%, now only down by 0.9%. We thought today might be dominated a little bit more perhaps by the BOJ, but as many had warned, expectations were riding too high into that BOJ meeting.
Yeah, expectations at least on the trading side. Economists were saying the BOJ is not going to do anything, and they didn't, but it maybe caught traders a little bit off guard that had been bidding for the yen and driving up yields on JGBs. But it is interesting to see some of that first initial move reversing. Maybe they're saying, okay, they didn't do it now, but it's still coming down the line.
Yeah, we'll see what comes with the change of personnel at the BOJ later this year. That is it for early edition. Surveillance is ahead. Plenty more from Davos. They'll be keeping their eye on the oil markets. Fatih Birol joins the team from the IEA. This is Bloomberg.
a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is a rally, no doubt.
The danger is we're falling into the same traps that markets fell into at the start of 22 and at the start of 21.
A little choppiness near term in our opinion, but we're more constructive on 2023 than I think most are.
Maybe we're seeing, some sort of regime shift when we see the pressures from inflation, the pressures from interest rates.
Financial conditions have been easing. I don't think you can really make much of a case right now that people are going to just spontaneously increase their rates of savings.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Farrow. Equity futures this morning on the S&P 500 up around 0.1%. What's that banking about?
Bank of Japan.
You're just banging the pen around the Bank of Japan? Okay. Do you want to start with the BOJ?
No, there's a lot of places to start. Let's start with retail sales this morning. It's retail sales Wednesday here. It's very important. McKee will be by to dress that up. That's 70% of the American economy.
Should we start with some of that spending? United Airlines beating a raise after the close yesterday afternoon. The stock's up in a pre-market. Yeah. United Airlines year to date, and I want to be very specific. Year to date, like since the start of 2023, like two weeks ago. That's good. Stock's up 35.8%. Well, what a move in just a couple of weeks.
They have a Pacific heritage here, and maybe that has to do with the news from Davos. The core news from Davos dovetailing into what to expect from retail sales in a non-recession is the Chinese driving the message. The cover of the FT this morning, our Tom Hancock last night about 9 p.m. writing up the message from Xi and his associates is China's open for business.
So we've got this big battle right now, this debate over recession or recovery, and we can talk about that. But let's talk about the context of all of this, which is a central bank decision from the BOJ, unchanged, not doing anything. One more meeting to go for Governor Kuroda in March before he hands over the reins to somebody else, Tom, in April.
Tonight at about 7 p.m., we'll get inflation data for Japan, and it looks like it could be by survey 4% top-line nationwide inflation. Among the 45 headlines that were out, John, this one really caught my attention from a guy leading this experiment, Kuroda-san. Regrettable that sustainable inflation not attained yet. If you're pumping 4% inflation in Japan, you've got sustainable inflation.
Well, he's had 10 years, and he's thrown pretty much everything at it, Tom. What more can they do? They basically own the whole bond market, don't they? I mean, I'm joking. They own close to half the bond market, the JGB market, TK. It's pretty wild stuff.
Well, they say half, but some of those tranches, they own all of it, or even on a hedge basis. Yeah. I don't want to go, it's too early for the math of it, but the answer here is they surprised in December. They shocked this morning by doing nothing. That's what central banks are really good at. And then what's the next 6 weeks out, again, when the market tests them? And, I go back to Soros and Bank of England here, whatever decade that was in, and this is the markets trying to break Kuroda. And it's tough to bet against the markets here.
Well, he's pushing back today. 129 on dollar yen, positive by about 0.8%. That currency pair had a 2.7% move against the Japanese yen a little bit earlier this morning. In the bond market, if you can pull up the screen briefly, we'll whip through things. A bid into the bond market, 10-year Treasury yields lower, down by about 7 basis points. A break of 350 on a 10-year, 347.57. Equity is just a nudge higher by 0.1% on the S&P. And crude, we'll keep an eye on this too.
Yeah.
81.68.
United Airlines.
WTI at 1.9%.
And every time this is true, folks. Every time I look at the screen, once a day, twice a day, Brent crude's up 87 and change. When do we round up to 88? We're not there yet.
One more stock to look at, Microsoft. Reports from Sky News, of all places yesterday in the UK, that we could be getting 11,000 job cuts out of Microsoft. We had one really interesting call on the south side, Tom. The first bearish call on the stock in 3 years. 3 years, we finally get a sell on the stock, and it comes from Guggenheim. And the individual at Guggenheim said this, Tom: most investors see Microsoft as a large, stable business that can weather any storm. It has vulnerabilities, some of which could be exacerbated by this macro slowdown. We're in a prolonged macro slowdown. No one is immune, was that note in the last 24 hours.
That's the call there on the macro economy and how it folds into big tech. I would fold it into Goldman Sachs, and that they've got all their labor challenges. And I believe they had expenses go up. I mean, you still got to run the place, and it may be a different mix of people at Microsoft. But the idea that they're going to diminish their labor thrust, I don't buy.
That stock was challenged yesterday, that's for sure. We'll talk about the banks a little bit later this morning. Good morning to you all. We can kick off our program with Thanos Vanvakidis, Global Head of G10 FX Strategy at Bank of America Securities. Thanos, can we start with that BOJ non-decision? How does that set things up for March?
Well, the Bank of Japan likes to surprise investors. Perhaps they remain on hold because most of people were expecting them to move. However, they are on an unsustainable path, and what they did during the holidays has opened Pandora's box. Inflation now is well above their target. We expect that it will remain actually well above 2% this year. And although they are right not to start a proper policy normalization cycle, I think they don't need unconventional policies anymore. So the market believes that it's a matter of time when, at some point this year, sooner rather than later, they will have to get rid of yield targeting and bring rates back to zero. And the market will keep testing them.
Thanos, so major shout out to Ambrose Evans-Pritchett, the Telegraph, who featured this chart yesterday. It was from Bloomberg. Let's go to it right now. And it's real simple. There's the yield chart in red. And for those of you on radio, all you need to know is the so-called yen swap pair has exploded out to a much higher yield, and that is highly unusual in the case of this chart going back 5 years. Thanos, it's as if the market is speaking to Mr. Kuroda right now. What is the power of the market to tell the governor of the Bank of Japan what to do?
I think if the Bank of Japan keeps defending the target, at some point you have to start being concerned about unsustainable increase in their balance sheet. After all, this is what led them to go into yield targeting in the first place. And particularly if we are right that inflation will be sticky, then the market will be right to keep actually expecting that the Bank of Japan will need to move. So what they're doing, I don't think will be sustainable, and soon they will realize that they cannot defend this target anymore. Again, I think the Bank of Japan is old school. They like to surprise markets. Maybe they will do it when market least expected.
Right.
But I don't know if they will find the proper window now, because the market has a very strong belief that they are moving in this direction. And again, what they did in the holidays has led to this situation.
Thanos, the 20, 30 headlines, 40 headlines that came out with the Bank of Japan today, the biggest shock for the street was the low ball on inflation, where they're looking well sub 2% inflation. I've got a print tonight, roughly 7 p.m., maybe 8 p.m., where they're looking at nationwide 4% top line CPI. Are they lowballing inflation, and are they going to get to a point where they have massive negative real GDP because nominal's not there and the inflation rate is elevated?
I mean, you're right. On the one hand, inflation pressures in Japan are not as strong as in the rest of the world. A lot of it is imported inflation, but core inflation is also increasing. And they have to be very careful. On the one hand, they were trying to inflate the economy, but they don't want persistent inflation well above 2%, because down the road, this could create fiscal problems. That's why I'm arguing that they don't need to tighten anywhere near to what other central banks are doing. But if they keep their conventional policies, this will add to inflation risks. So they should strike the right balance, especially if inflation keeps surprising to the upside compared to their forecast. This will allow them actually to move in this direction.
Next stop for the BOJ is in March. Next stop for the ECB, early February, the day after the Federal Reserve. Thanos, can we finish there? There was some speculation yesterday, encouraged by a news report here at Bloomberg, that there could be a step down. After the next hike of 50, they go towards 25. Some pushback from an ECB official speaking to Francine Lacqua in Davos this morning. Where are you on the trajectory for ECB rate hikes? Where is the path? Where do you see the terminal rate over at the ECB in Frankfurt?
We have terminal rate at 3.5%, so we see 50 bips in the next two meetings. I was personally surprised with the headlines yesterday. I thought that in the December meeting, for the first time, the ECB gave a clear message that they will do whatever it takes to fight inflation. Data in Europe are surprising to the upside. Inflation is still high. Core inflation has not peaked yet. So I think they have to stay the course and continue hiking. If anything, the risk for an even higher terminal rate than 3.5%.
Amazing. Thamos, thank you, sir. Thanos Vamakidis there of BofA. Off the back of that story yesterday, euro dollar, a brief break of 108, back to about 108.
What is the view there? I don't know. 110, 112, what's the
My view
consensus?
at the moment on the ECB, to be clear, and not the currency, is that there is some division emerging. And that's indicated by our story yesterday, suggesting that there could be a conversation about stepping down from 50 to 25. But to Thanos' point, there was very clear guidance from ECB President Christine Lagarde, who at the same time is telling us she's not doing forward guidance anymore, that they would do 50 for the next few meetings.
I'm not doing forward guidance either after this week. What I would suggest, John, is you don't have a glide path in Europe as defined as you do in the United States. I mean, I'm not saying we're going to 2% here. That's the official line. But the answer is there's a real belief in disinflation in the United States. I don't hear that in 10% United Kingdom. I don't hear that in maybe it's 8-9% Netherlands. I don't get the glide pathiness of it that I get in.
Well,
the
they had two
United
problems,
States.
didn't they? They had two problems. One was that inflation was too high. The second was that growth was too weak. And seemingly on the growth front, I wouldn't say things are good, but they're certainly better compared to where they were.
Well,
we spoke to Chancellor Scholz yesterday, who spoke to John Micklethwaite, our editor-in-chief on Bloomberg TV in Berlin. I think Scholz was pretty clear. We can escape recession here in Germany. He was convinced of that.
That's a manufacturing dynamo, and I'd even put the Netherlands in that group. There's a lot of other places that aren't like that within Europe, but I'd say the same nominal GDP worry in Europe is the same as in Japan. I walked through that with Thanos there. The math, folks, is nominal GDP less inflation equals real GDP, and financial media just goes to real GDP all the time. I don't agree with that.
To see the depot rate, Tom, at 2, after being negative
This is
for so
ECB.
long. Yeah, and to hear Thanos there say we can get to 350 and maybe they'll even have to go higher. All this stuff was unthinkable 12 months ago with the European Central Bank, and here we are.
Yeah, I think the unthinkable is what we're talking about here, and the answers we're going to adjust to it. The elephant in the room to the salvation of Europe, the salvation of Japan, and all the other worries that are out there is a burgeoning China, and that was the single message out of Davos yesterday from the Chinese
Massive
leadership.
change. You heard from Bramo. She's skiing this morning.
I talked to Barry last night late, it was like 3 a.m. their time, 9 p.m. our time.
What did you learn?
I said, Barry, is she there singing Sweet Caroline? And he said...
She was at the bar singing?
Sweet Caroline, yeah,
After a few drinks, or just turned up sober and started singing?
Barry didn't want to go there. He protects the innocent.
Okay, that's pretty cool.
That's why Barry's
Well, good for her. I'm pleased she's having a good time.
Sweet Caroline.
Oh, were you about to sing?
Whoa.
Nice.
Thank you.
Don't we have music rights? Can we play some of that?
Steve Pagliuca, he got Neil Diamond to sing at Fenway Park. That's pretty cool.
That is pretty cool.
Whoa.
Okay, Laurie Heinel's coming up in the next hour from State Street Global Advisors. Looking forward to that. Futures this morning up about 1/10. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. U.S. Treasury Secretary Janet Yellen sat down with her Chinese counterpart today in Zurich. It's Yellen's first face-to-face meeting with Vice Premier Liu He. Now, before the meeting began, Yellen said that misunderstandings must not make the relationship between the two countries worse. Inflation in the UK dipped in December for the second month in a row. According to government figures, consumer prices rose 10.5% from a year earlier. Still, inflation is 5 times higher than the Bank of England's target. The central bank has raised interest rates 9 times in a row since December 2021, and another rate hike is likely next month. In Ukraine, the country's interior minister was among those killed when a helicopter